Hi friends, a small intro video before you see the main video. Uh, these are concept revision videos for AFM, costing, or FM. Objective is very simple. Learn concepts with limited amount of time. Post concepts, do practice. These are applicable for first time learners as well as new learners, and these are taken from my regular or exam oriented sessions. Now you move to the main video. Okay, now we move to the next chapter, which is on mergers and acquisitions and corporate restructuring. One chapter, mutual fund, is fully over. Let's discuss first M&A little basics, and then we start doing questions and concepts around it. Now, merger is basically an exercise where two companies join together. Examples, many examples, practical world is there. In telecom, there was idea along with Vodafone merge themselves together and call it as Vodafone Idea. And many of the state banks, State Bank of India, State Bank of Travancore, all those mergers have happened in the practical world where two companies join together and the business is transferred to a single merged entity. In accounting, you have acquisition, merger, all that doesn't really matter for us. Basic logic is very simple. Two companies are going to join together and it will become a single company. Now, merger by definition, there will be a single merged entity. Acquisition by definition, one company will acquire the another company, and technically the larger company will start continue with the business. Doesn't really matter for us. Now, why should a merger happen? There are two major reasons. Logical reasons are two. The third one is more of not logic driven, but more of other factors. One is called operating synergy. What is operating synergies? State Bank of India and State Bank of Travancore merged together. Near my home, there was an SBI branch. There was also an SBT branch. Both were there, very close to each other. Moment merger happened, one of the branch got closed by them. Zero impact on customer. Customer did not feel bad about it that a branch got closed. They were able to serve me properly. But earlier unnecessarily double cost was getting incurred. Now they have reduced the cost to single. They have closed down some of the branches because when you merged it together, you did not feel the need to have another branch. When you merge them together, you may get economies of scale benefits. Vodafone, Idea merged together. Whatever purchases they are doing, now double purchases. So able to negotiate better, improved market reach, and competition can go down. Objective of operating synergy is to improve P&L. What is improvement in P&L? Profit after tax improvement. What is PAT improvement? A, 100 crore. B, 50 crore. Together 180 crore. 100 plus 50 has become 180, 190, 170, 160. That is called operating synergy or cash flow. You can call it as PAT or you can call it as cash flow. This is one reason. Second reason is financial synergy. What is financial synergy is there is a company which has lot of good projects, but nobody is ready to give loans to me. I am a very good company, have lot of good projects to do, but people are not ready to give me a loan. I got acquired by Tatas. Tatas have lot of money. I have lot of good projects. We merge together. Lot of money, lot of projects merge together, and projects start happening. It will give me operating benefit as well as financial benefit can be there. What is financial benefit? I was earlier going to the bank. Now also I go to the bank only. Tata's had money, but still they said let's take a loan. Earlier bank was not giving me loan. Now bank is very happy to give me a loan. Earlier bank gave me a loan 15% rate of interest. Now bank is saying 10% rate of interest. So financial synergy is improvement in one of these. Cost of capital. What is cost of capital? Is WACC, which you would have learned at CA Inter. Cost of capital improvement is there. Or a concept called P multiple, price earning multiple. This is going to be extensively discussed in this chapter. Price earning multiple improvement. How does this lead to value improvement? You will understand. None of these two are there. Then the merger will not have any gain. There is no P&L benefit. There is no balance sheet. Financial synergy is more of a balance sheet benefit. None of them are there. No benefit. as far as merger exercise is concerned. Then why is it happening? Managerial self-interest, empire building, stronger management team. It can be managerial ego also, or promoter, three sons. He wanted three business for all of the three people. Two businesses are there. Acquire one more business and give this one business to another guy, saying that you handle this business. So there can be multiple reasons a merger happen. Logical reason is operating synergy. What is operating synergy? Part of company one plus part of company 2 becomes more than the individual sums. Or cost of capital of first company 20%, second company 10%. When you club them together, somewhere between 10 and 20 you should be there, but you make it 8%, 6%, 5%. That is called financial synergy. How does this happen and all, we'll understand as we proceed. Now, every question for merger analysis, we have a format which we need to be aware of, and this is the format I'll be extensively using in this chapter. The term AC means acquiring company, TC means target company. These are the two terms we will be using extensively. Acquiring company is there, there's a target company. Let's understand this with my calculation which I do here. Format, you keep it open with you, but you see the explanation now. Particulars, there is a acquiring company, there's a target company, and there's a merged company. Starting is PAT, technically EAS, okay. Preference dividend all is zero in practical world. No companies will have preference dividend, very rarely you see. So PAT is the starting point. First company making PAT of 1000 crores, okay. Second company making PAT of 500. Very happy scenario. 1000 plus 500 plus extra 200. Extra 200. In the merger, some benefit has happened. This became 1700. This became 1700. Number of shares. I had 100 shares, had 20 shares. When I club them together, 100, the acquiring company will continue, okay. Acquiring company is the one which will continue. So when you merge them together, 100 plus you may allot any number of shares to the other entity. How it is allotted, all that calculation will understand as we proceed. So I went and allotted 25. I went and allotted 25. I can allot 20, 25, 30, 50, 4, 5, 10, 15, any number it can be. This is a very, very important exercise in understanding how much we have to allot. So I allotted 25, became 125. This gave me BVPS, PAT divided by number of share. PAT divided by number of share. You would have learned this in your CA Inter itself, and you also have an accounting standard on this, which talks about earnings per share computation. My earnings per share is 10 rupees, 25 rupees, and 13.6. 13.6. Any doubts till this? EPS. This is a very important calculation. Then I have a multiple called PE multiple. What is PE multiple? Is price by earning multiple. Price by earning multiple is 10. So earning into this multiple is price. Earning into this multiple is technically called as price. If some of you, if you have tracked things, you will understand there is a continuous debate on Lenskart valuation, where they keep on talking about a P multiple. If at all you have gone through some of the news article, they'll say why such a higher P multiple, why such a higher valuation. There's a continuous, as around 230 times or something. So P multiple is one important metric in the valuation. So P multiple, let's assume, is 25. When you merge together, ideally somewhere in between the multiple has to be. If the multiple is not in between, or there is a weighted average, you'll understand as we proceed, but somewhere in between it has to be there. I get it maybe 30. Get it as 30. Some reason. Let's understand the reasons later. 25 and 10 is not exactly weighted average. What is weighted average, you'll understand, but if it's not exactly weighted average, financial synergy. Financial synergy. 1000 plus 500, if not 1500, operating synergy. Operating, so there is operating synergy as well as there is a financial synergy. I multiply these two, I get MPS. Multiplication of these two will give me market price per share, which is into 25 25 into 10, 13.6 into 30, 408. Any doubts till this? Then comes number of shares again, value of firm. We normally use the word firm rather than company, but both are technically same. Number of shares is 100, 20, 125, 120 and 120. Value of firm is 250 into 100, which is 25,000. 250 into 20, 5,000. Ideally 25 plus 5 should become 30, but it is becoming 51,000. It is becoming 51,000. This is a classic example of operating as well as financial synergy. Operating as well as financial synergy put together, it is 51,000. I'll explain again. I have PAT. I divide by number of share. I get earnings per share. Multiply with price earning multiple. A constant discussion on this term is happening as far as Lenskart is concerned. Then you get you get MPS. Again multiply with number of share, and you get value of firm. How did I calculate value of firm? 250 into 100. This side 250 into 20. This side 408 into. Now, this is a derived formula. This is not the right formula. What is right formula is at into P multiple directly, because you divide by number of share, again multiply with number of share. The real formula of value of company is not number of shares into share price, which is what we will do. But the real formula is PAT into P multiple. What is PAT into P multiple? 1000 into 25. Either 1000 improves or 25 improves, value will improve. Either 1000 improves or 25 improves, value will improve. So the real formula is 1000 into 25. Other one is 500 into 20, 1700 into 30. Any doubts on this? Okay, this is all for your understanding. In case this had happened, no operating synergy, but still financial synergy will improve my value. Still financial synergy will improve my value. How does it improve? 45,000. 25 plus 5 is 45,000. 25. Don't look at the numbers and all. Understand logic. What I'm trying to explain is only the logic part has to be very clear. 25 plus 5 is becoming. Don't say how this number and all came, because Excel will keep making changes. 25 plus 5 has become what? 45. Ideally 25 plus 5 should become 30, but it has become 45. Reason? 25 and 10. Average you have written 30. What should have been this number? Somewhere between 25 and 10. I'll explain weighted average in some time, but it should have been, just give me a minute, maybe 20. 20 means no improvement. Weighted average of 25 and 10 is 20. If you had 20 as the number, no improvement in the value of firm. No improvement in the value of the firm. A question will say there is no gain from merger, which means no PAT level gain. No PAT level gain, but still P multiple can improve, value can improve. I'll repeat again. PAT into P multiple is the real formula for value of firm. Market value of firm, real formula. PAT into P multiple. PAT into P multiple. The formula which we use is MPS into number of equity share. Is that a wrong formula? Nothing is wrong. That is the formula you will use. Rounding off, if it happens, there can be a difference and all, but otherwise both formula will give same answer. Every merger exercise focuses on either PAT improvement or P multiple improvement. Focuses on PAT improvement or P multiple improvement. PAT, other name is cash flow. P multiple, 1 by P multiple is called cost of capital. All this you could have learned somewhere at CA inter level. So either COC has to improve, or P multiple has to improve, or cash flow has to improve, or PAT has to improve. If PAT is improving, it means cash flow has improved. If P multiple is improving, it means cost of capital has improved. Any doubts first on this? Clear? Gain from merger. Gain from merger arises if value of merge firm. Value of merge firm. What is value of merge firm? 30,000 minus pre-merger value of acquiring company plus pre-merger value of target company. 30,000 minus 25 minus 5 is the gain from merger, which is 0 in my example as of now. If I change this as 25, there is a benefit of 7,500. Benefit of 7,500. If I change 1,500 to 2,000, there's a benefit of 20,000. Benefit of 20,000. Gain from merger is post merger value minus the individual value. The entire exercise is happening because of this. And once this happens, two people will fight for this. Acquiring company will say, I should get this benefit. Target company will say, I should get this benefit. When I say acquiring and target, the shareholders of acquiring company and the shareholders of target company, which shareholder will get this benefit is the real discussion. Practical world. Some of the mergers have not passed through because there is something called as an exchange ratio, which we'll understand as we proceed. If it is not favorable for one set of people, they'll reject the merger itself. They'll reject the merger itself. Logic is this gain which is arises because of two reasons, but the real fight here is who takes that gain. Should AC guy take it or should TC guy take it, which is what the discussion is all about. Cash flow or PAT of the merged firm greater than the sum of individual company. Post merger PR cost capital is better than the weighted average. Better than the weighted average. Now this point be very clear. Merger gain is given in question. If the merger gain is given in the question, it 90% of the time means PAT gain. Some question will say there is no merger gain, which means no PAT level gain. No PAT level gain. In a rare scenario, this would directly mean no valuation gain or directly mean the valuation number. Very rare scenario. You will see that in a problem. Merger gain given in problem would indicate synergy gain or PAT level gain. In a very rare scenario, this could directly mean the final gain from merger. What is final gain in this? Here, PAT level gain is 300. Valuation level gain is valuation level gain is 20,000. If a question says merger has a gain of 500, that would mean PAT improvement of 500. Rare scenario. That 500 may be understood as 25 plus 5 plus another 500 is the final value of a very rare scenario. I'll explain that when I do the question. But normally merger gain given in the question would indicate what? PAT level gain. Some question will say no gain from merger. Student will think no final gain. No gain from merger means no PAT level gain. No PAT level gain. There can still be a gain at a P multiple level, because of which there can be a gain at a valuation level. Similarly, no merger gain would mean no PAT level gain. However, still there can be a valuation gain due to better P multiple. A small example just to quickly get started with. Cash flow of company A 25, nothing for you to write, okay? Company A 25, B is 20. Merge company will have cash flow of how much? Due to 25 plus 20 should be how much? 45. But merge company is getting how much? 60. Clear? That is the gain we are talking about. Pre-merger cost of capital is 10%. There is one way of valuing a company which you would have learnt as Gordon's formula. You would have learned Gordon's formula at inter level also. Gordon's formula said D1 means cash flow 1, K means cost of capital. So first company 25 lakh divided by 10%. That is the value of the first company. D1 by KE minus G. G is the growth rate, which is not given in the question. Let's not worry about the growth rate. First company 25 by 10%. Second company 20 by 20%. Merge together 60 divided by how much? 8%. And 250 plus 100 is 350, but merged is 750. Merged is 750. Why is this happening? Because of numerator increase, denominator decrease. Numerator increase, denominator decrease. Numerator increases, PAT improvement. Denominator decreases, P multiple or cost of capital. P multiple or cost of capital. Any doubts to this? Any doubts on this? Here, can we proceed? Understand one thing, be very, very clear. The entire focus of this merger exercise is PAT. This together should be more, or P multiple should improve. One of them happens, I'll be very happy. Both happens, great. It's a double benefit merger. Once this benefit is calculated, two set of people are fighting for it. That fight is through a ratio called exchange ratio. We'll understand this as we proceed. Any doubts till this? Any doubts on this? Understood clearly? Okay. Cost of merger or merger consideration. Whenever a merger happens, I have to obviously pay something to the other party. You have your accounting angle, which is different, and this is your analysis angle, which is a little different. Now, you can acquire a company in two ways. One is pay cash. Second is allot shares. Pay cash or allot shares. If you are allotting share, very simple, shares issued into post-merger market price. Post-merger market price. What is post-merger market price? In my example, into 400. Into 400. How many shares are issued? Extra 25 shares are issued. Extra 25 into 400. Extra 25 into 400. What is post merger market price? Be very, very clear. What is consideration paid is number of shares issued into post merger market price. Post merger market price. This is technically, if I am that other company shareholder, I will get this, and if I don't like it, I'll immediately sell and get the money. Immediately sell and get money from the company, because after merger happens only I can sell it, and at that date the price quoted will be post merger market price. It's not pre-merger, it is, and it's not even issue price. Okay, not even issue price, post merger market price. Not very sure on the accounting angle, but here it is post merger market price. Purchase consideration will be multiplied with what? Post merger market price. Cash means very simple, number of shares into cash paid per share. You can pay cash, you can also go through shares consideration, that's your wish. If you are going through shares consideration, number of shares issued into post merger market price. If you are going through cash consideration, then technically I don't allot any shares. So whatever was the original shares, 100 plus 20 will become 100 only. 100 plus 20 will become 100 only. No change. No change in the number of share. 100 plus 20 will become 100. But I will be paying some money. I'll be paying some money. Any doubts till this? Any doubts on the concept till this? Can we proceed? Done. This is called gross cost. What is net cost? You would have learned something called as goodwill or capital reserve calculation. Similar logic. Similar logic. What is net cost? Is whatever you paid minus what was the value of this company before merger happened. I'll come back to this example now. I'll come back to this example. Gross cost. Gross cost equal to how many shares we are allotting? 25. What is the post merger price? 25 into 400. Net cost. I gave 10,000. What is the value of this company, the second company before merger? 5,000. 5,000 extra I have paid. Total gain from merger. What is total gain is post merger value minus the individual pre-merger value. Individual pre-merger, post-merger value minus the individual pre-merger. I'll be explaining this 3-4 times till you get full grip on this. Post-merger value is 50,000. Individual pre-merger value. Now the fight is between AC and TC. Who will take 20,000? TC guys, I said I'm giving you 5,000. I'm giving you 5,000 extra. I'm giving you 5,000. AC gain 20,000. 15,000 is my gain. 15,000 is my gain. There's a fight between AC and TC. Can I give more? Yes. In place of 125, make it 130, 135, 140, 145, 150. You keep changing this number, you will keep getting more and more benefit. You will keep getting more and more benefit. That is a discussion happening between the AC and TC. TC guys will say, don't give me 25, give me 30, 35, 40, 45, 50. This guy will say, I'll give you 25, 20, 15, 10. I'll keep reducing the number of share. He'll keep increasing the number of share and a fight will keep happening. And finally, a ratio will get decided. Now, how is this 15,000 coming to AC? AC is very simple. I had 100 share earlier. Each share was value 250. Now, if I am the shareholder, I'll continue to have 100. As a shareholder, AC shareholder will continue to have 100. And now my value is 100 into 400. Earlier value is 100 into 250. Very, very happy with this exercise. I am very happy with this. 100 into 250 has become what? 100 into 400. I'll repeat again. PAT, number of shares, EPS, P multiple, MPS, number of shares, value of firm. Two sets of people are fighting on who will take that, gain. What is the gain? Total value post merger minus the individual pre-merger values. Total value is 50,000. Individual pre-merger values is 25 and 5. 20,000 is the gain. Okay, now the fight has started. Originally, I did 125. Okay, now I'll change the number. Okay, I'll change this number to. Just give me a minute. Okay, I made it as 200. Let's just imagine it is 200. 100 plus 20 has become 200. This merger may pass through, may not pass through, but I made it as 200. Now what I have given gross cost is, how many shares we allotted extra? 100 plus 20 has become 200. Extra 100 shares I allotted. What is the post merger price? 50. 25,000 I gave it to the other party. 25,000 I gave it to the other party. Net cost 25,000 minus 5,000, 20,000. Overall gain of merger 30,000 minus 25 minus 5. 20,000 was the gain. I gave you entire 20,000. I am left with only 0 now. I am left with only 0. How am I left with 0? 100 into 250 remains 100 into 250. For me, 100 into 250 remains 100 into 250. The fight is always on who takes that gain. Clear? Able to understand till this? Any doubts on the concept here? I'll repeat one more time. Final time I'm repeating. The objective of the merger is to increase the value of the firm. Post merger value minus the individual pre-merger value, there should be some difference. Which is what we are trying to get. We are trying to get the gap. There will be a benefit. That benefit can be 1,000, 10,000, 2,000, 3,000, 5,000. This benefit, two set of people want it. Acquiring company wants it. Target company also wants it. Target company, I give him and tell him that this is what I'm giving you. What will I give him? Stock offer, number of shares issued into the post-merger market price. Cash offer, cash paid per share into the number of shares. Net cost or true cost, can you come to page 188? You can write this as TC gain. This is TC gain. Target company's gain. This net cost or true cost is target company gain. Page 188. Target company gain. This is the gain for the target company shareholder. Acquiring company balancing figure. Acquiring company's balancing figure. Any doubts till this? Overall gain. Okay, I think with this the major discussion will be over. Post merger value minus the pre-merger value of AC and TC. True cost of merger, net cost of merger, or gain. This is what I told you to write there. Gain of TC shareholders. Gain of TC shareholders is gross cost minus the pre-merger value. Whatever is the total gain, from this I give you something. For my entire discussion, you are TC. In the class also, you are TC. I am the acquiring company. So whatever I give you, balance is my gain. Whenever I say my gain, acquiring company, your gain is target company. So total gain minus the net cost of merger. I'll obviously try to give you lesser gain and I'll try to pocket a higher gain. A good merger is one where both gain at least something, not more, less, and all, but at least both have to gain. If one of them has a negative gain, merger will fail. Merger will fail if one of the party is having a negative gain. Can there be a negative gain? Yes. If I try to twist the ratio too much, one party will have negative gain, another party will have huge positive gain. Merger will not pass through. Clear? Any doubts till this? Any doubts on this? I'll come back to other concepts in some time. Any doubts till this first? Any doubts on this? Four concepts we have done. Main part is very simple. We are valuing the company. What is valuation? Not number of shares into price. It is PAT into P multiple. Improve PAT, improve P multiple, gain will arise. This gain gives something to you, something to me. If that happens, both parties are happy. Whatever I give to you, balances mine. Balances mine. Clear? Any doubts on this? Can we proceed? I still have some more concepts, but I'll come back after a problem. Let's come to question 2. This is question 1 of the priority material. A Limited wants to acquire T Limited and has offered a swap ratio of 1:2. That is half share for every 1 share of T Limited. Following information is provided: PAT, equity shares, EPS, P ratio, market price per share, number of shares to be issued, EPS after acquisition, equivalent EPS, expected market price, market value, what should be the exchange ratio to achieve EPS of 3.5 in case the synergy benefits are 10%. Calculation shall be rounded off to 2 decimal. Go through the question. I'll give a minute and then I start doing it. A minute for you to go through. Okay, let's start doing this. A Limited wants to acquire T Limited. I have given a swap ratio. What is swap ratios? I'll be giving 1 share for every 2 share. How is this ratio calculated and all? We'll see as we proceed. This is a very important number. The swap ratio is the most important number. A merger passes or fails due to swap ratio. 0.5 share for every 1 share. They've asked for equity shares to be issued, EPS, equivalent earnings, expected market price, market value. All this will come from the table, most of it. Let's put the table. Merger table. I call it as merger table. Most of the question will be done in this table. Merger table. Particulars. Listen for a minute. Listen 1 minute alone. AC. Listen for a minute. TC. Merged, have space for extra 2 columns. Okay, I may do a merged rework. I may not do in some question. Have space. When I say rework, that time don't tell space is not there. Then again you will have to write the same table again and then end up doing it. So extra space is preferable to do any rework. This question will need 1 rework. Some other question may need 2 rework. 2 rework. Let's do space. More than that, then again recreate the table. So acquiring company. Tell me which is the acquiring company. That's right. Acquiring company. Which company? A Limited. Target company Limited. So we normally write acquiring first, target second, but it's not mandatory. Okay, it's not mandatory that it has to be this way. You can change the order and all. Now I teach it this way. In exam, students went with that mindset. They saw that it will be acquiring target, acquiring target. One exam they did target acquiring, and student made a mistake. So it is not mandatory that it has to be acquiring target only. Sometimes they may give the table target first, acquiring second. There's no specific order in which you have to write it, but preferable acquiring first, target second. So write A Limited, T Limited, merge. Write the format: PAT, number of equity shares, number of equity shares, EPS, P multiple, MPS, number of equity shares, MV of firm, market value of firm. Calculation, everything is going to be very, very simple, except a few new things I'll have to add. That's all. Was a PAT given? 18 lakh and Any merger benefit the question is talking about. Any benefit on the merger. Nothing talks about added. That's all. 18 plus 360. 360. There's a rework where some benefit is talked about. We'll see that later. 18 plus 360, 21, 60. How many shares? 6 lakh. 6 lakh plus. I'm allotting some ratio. What is the ratio they've said? 1 is to on this 1 lakh 80. I'll do into 1 by 2. I'll be allotting 1 share for every 2 share into 1 by 2. 1 by 2. 6 lakh 90,000. Question has told us to do 2 decimals, so I'll restrict my calculation to 2 decimal. 18 lakh by 6 lakh is 3. 360 by 180. 2160 by 690 is 3.13. PAT divided by number of equity share. Price earning multiple could be given in the question, which is 10 times, 7 times. Post merger, the question has said, what is the expected market price per share of A Limited after the acquisition, assuming its P multiple remain unchanged? A is acquiring it. Post merger, whatever was the pre merger P multiple of A Limited is the post merger P multiple of the merged firm, which is same times. Now, in this question, there will be a valuation gain. Reason is 10 and 7 averages 8, 9 something, but you are writing 10 itself. You are writing 10 itself. This will lead to some benefit. You will understand in the calculation. 10, 7 became 10 times. Any doubts on this? Any doubts on this? Multiply now. 3 into 10, 30, 2 into 7, 14, 3.13 into 10, 31.3. Number of share copy paste again. 6 lakh, 1 lakh 80. For calculation purpose, I'll do the multiplication, but logical formula is PAT into P multiple. We will not have any difference in A and B. That is second column and third column, no difference. Acquiring target. Merge, there will be difference because of rounding off. Because your EPS was rounded off. If I had not done rounding off, I'll get the same answer. Because we have done rounding off, there will be small variation. 30 into 6 lakh. 1 crore. Real formula is 18 lakh into 10. Real formula is 18 lakh into 10. It is not 30 into 6 lakh. Understand, real formula is 18 lakh into 10. 18 lakh into 10. Writing everything you can do it this way, but real formula is only 18 lakh into 10. Next one, 1 lakh 80,000 into 14. How much? Again, real formula is 360 into 7. 360 into 7. Post merger ideal is 2160 into 10, 2 crore 16 lakh. Ideal answer is 21 lakh 60,000 into 10 times into. Will there be a variation in answer? Yes, we did some rounding off. Because of that, there is going to be variation in answer. Any doubts till this? Other side, 31.3 into 6 lakh 90. 2 crore rounded off. You will write both the answer. How you got 2 crore 16 is PAT into P multiple. Rounded off 2 crore 16 lakh PAT into P multiple. PAT into P multiple. Any doubts on this? Once the table is done, we will write a solution. Table itself has most of the answer, but I'll write it separately. Any doubts till this? Any doubts on any of the numbers here? Can we proceed? Down solution. Solution. What is the first requirement of the question? Number of shares issued 90,000 shares. 90,000 shares. Clear? Second requirement, EPS after acquisition. Look at the above table. Post merger, what is the EPS? 3.13. I'll come to third part in some time. Equivalent EPS, we'll see later. Market price after acquisition, part 4, 31.3. Equivalent EPS, I'll explain in some time. Market value of merged firm, 2 crore 15 lakh 97,000 or 2 crore 16 lakh. Ideally, both will give same answer. Pattern to P multiple are this, rounding of differences there. Any doubts on this? What should be the exchange ratio to achieve EPS of how much? In case synergy benefits are, synergy benefits means PAT level gain. PAT level gain. I want EPS of how much? 3. Another column, rework. Another column, rework. If you have space, okay. No space means you'll have to repeat the table. Rework. 21 lakh 60 plus extra 10%. 2376. Extra 10%. There is a synergy gain of 10%. Synergy gain would mean PAT level gain. Extra 10% is there. They have given me a target EPS. What is the EPS they want? 3.5. Listen, beyond this, not needed. You need not write this also in exam. I'm not doing all this calculation. Can I complete the table? Yes, I can complete it. Number of shares is balancing figure. Tell me the number of shares. 3.5 EPS, number of share balancing figure. Divided by 3.5. 6 lakh 850. That extra 78 is the shares allotted. Extra 78 is the shares allotted. Can I do without table? Yes, you can do without table also. It's all up to you. If I was in exam, I would not do the table. I will find it easy to do it without table, the last part. Other parts with table is easier. Last part without table also I can do it. Any doubts till this? Any doubts till this? Any doubts on 678, 857? Clear? Below the table. Exchange ratio or EPS of 3.5. For EPS of 3.5, how many extra shares? 78, 857 shares for 1 lakh. 78, 857 shares for 1 lakh 80,000 OR 78857 divided by 1 lakh 80. Point is to 1. Originally I wanted to give 0.5 is to 1. Now I changed my mind and made it as 0.4381 is to 1. Any doubts till this? Clear? No gain calculation, none of that is asked in this question. Any doubts on this? Can we proceed? Done? Okay. Question I asked for equivalent EPS. Let's understand the concept and then I come back here. Very simple concept. Whenever I do a post-merger EPS or an MPS number, if I am an acquiring company, whatever is the price is logically my price. Reason is earlier I was holding 1 share. Now also I'll hold 1 share only. Earlier I was holding 1 share. Now also I'll hold 1 share only. So whatever you calculate, that is the normal number without any adjustment for me post-merger. But for you, if I say 3.13, you don't get 3.13. You get half of only 3.13. Reason is exchange ratio was 1:2. So we do a equivalent number. What is equivalent number? Post merger can be EPS, can be MPS, can be BVPS, anything can be. Post merger EPS or MPS into exchange ratio. You unfortunately earlier 1 share 2 rupees EPS, half a share 3 rupees EPS. Now don't tell me 2 has become 3. No, 2 has not become 3. First give me the equivalent number. So if you see in this question, earlier it was 2 rupees. becoming 3.13 direct benefit for me. 2 becoming 3.13 is not your benefit, okay? You cannot say 2 has become 3.13. For you, the relevant number is half of 3.13, which is called equivalent EPS. Half of 31.3, which is called equivalent MPS. Equivalent MPS, equivalent EPS, anything question can say. Anything question can say, I have to do an equivalent number. I'll have to do a equivalent number. Any doubts on the concept here? For me, directly 3 became 3.13, 13 paise benefit. 30 became 31.3, 1 rupee 30 paise benefit. For you, 2 did not become 3.13. For you, 2 has become half of 3.13 and 14 has become half of 31.3. Half of, that is called equivalent number. That is called equivalent number. So equivalent number means post merger EPS or MPS, can be any number. They can ask post merger equivalent EPS, equivalent MPS, equivalent BVPS, whatever they ask, into the exchange ratio. Why are we doing this? Post merger EPS, MPS will not be the correct EPS or MPS for whom? TC shareholders. This is because their one share can become 0.25, zero point 0.5, 1.25, etc. Depending on what? Depending on the exchange ratio. Clear? Any doubts on the concept here? Any doubts on the concept? All right. Equivalent EPS. Equivalent EPS. Equivalent EPS. Normal EPS into exchange ratio. Normal was, I think, 3.13. Exchange ratio is 0.5. We are doing the original part only, okay? That 0.43 was a rework scenario. 1.565 per share. Clear? Whether you're gaining, not gaining is a different story. 1.565 per share. Any doubts on this? Can we proceed? Let's come to this question. You have been provided the following financial data of two companies, particular Krishna Limited, Rama Limited, PAT. Wait, I'll tell you what and all has to be done. Listen for some time. PAT, equity shares, outstanding, EPS, P ratio, market price per share. Company Rama is acquiring company Krishna. Company Rama is acquiring company Krishna. By now you would have known why I have discussed this question. They have changed the order. They have changed the order. I normally introduce this changed order after 5-6 question. I've introduced here itself because the mindset is always acquiring company first, target company second. Here they have twisted. Rama is acquiring Krishna, giving what? 1:1 basis. Exchange ratio is based on the market price of the shares of two company. This based on market price has zero implication. You will understand later. 1:1 as of now. What will be the EPS post merger? EPS post merger, put it in the table. What is change in EPS? I'll explain that. Market value of the post merge firm, the table will give you the answer. Profits accruing, that also I'll explain. So we are now going to put it in the table format. Only thing is Rama first, Krishna second, merge last. Merge last, same table. Let's complete the table. Once the table is completed, part 1 and part 3 will get over. 2 and 4 is a new concept which I have to explain. Let's put it now. Particulars, only 4 columns are needed. Rework may not be needed, but again, my request to you remains the same. Have extra space. This question rework is not needed. Particulars. Before you start, right. Acquiring company. This will force you to think. Which is the acquiring company? Which company is acquiring? Rama Limited. Target company. Krishna Limited. Rama Limited and Krishna Limited. Order is Rama, Krishna merged. You do in your notebook. I am doing it in the screen. You can check once you are done. There's nothing to be explained here. All the numbers are there. You write in your notebook. I'll be writing it in the screen and we'll discuss. Rama, Krishna, PAT is given, equity shares is given, EPS given, P ratio given, everything is given in the question. You keep writing the numbers. I'll write it in a minute on the screen. Again, I think it is talking about 2 decimal. I don't see any confusion in these numbers, but still, if there are doubts, you'll have to tell me. They have said post-merger P multiple is equal to the pre-merger P multiple. So same 14 has been continued in the calculation. 237.72 rounded off 238. Why that much variation? Because of rounding off only. So that part we can't help it. Anybody needs any explanation? Most of you would have been used to the format, but some of you are new students of mine. So anywhere there are challenges, you will have to tell me. Any doubts on this? Can we proceed? Any doubts in this calculation? Done? Can we? Okay, now listen. Question is saying, what is the EPS subsequent to merger? Answered. Right. EPS post merger. EPS post merger 2.83. EPS post merger 2.83. Then they have also asked for market value. Market value post merger 2 crore 37 lakh 72,000 OR 2 crore 38 lakh. Which will be there in ICA solution? Not sure. So that's why I'm giving you the other number also. Ideally, difference should not come. Difference coming is more because of rounding off. 237 and 238. Can we proceed? Clear? Able to understand till this? Any doubts in the number? Now, change in EPS for the shareholders of companies Rama and Krishna and profits accruing to shareholders of both the company. Let's discuss this element now. Profits accruing to both the shareholder. What is both the shareholder? How much is I am gaining AC and how much are you gaining TC? What is the gain to both the set of people and what is the change in EPS? Change in EPS. Now listen, 2-3 minutes, an important concept, and then I come back. Gain or loss per share, impact of merger on earnings per share or market price per share. Now, what is this impact is? In this question, tell me what is the post-merger EPS? 2.5 is becoming 2.83, 33 paise gain. 33 paise gain. Krishna Limited 3.5 is becoming 2.83 into 1 by 1. 2.83 into 1 by 1 loss of so much. Clear? If I go from a price point of view, 35 is becoming 39.62. 35 is becoming 39.62 into 1 by 1 into 1 by 1. So this is the format. Heading C, acquiring company shareholders. I don't use the word acquiring company here because I'm calculating specifically for the shareholders, not for the company, because both the target company will be wiped out. It will not continue itself. So AC shareholder, TC shareholder. What will you write? It can be MPS based analysis or EPS based analysis. MPS based, normal value minus normal value, post merger normal value, pre merger normal value, gain or loss per share, multiply with the number of share, overall gain. Target company, equivalent value, equivalent value minus the pre-merger value, you'll get the gain or loss, multiply with the pre-merger number of share, earlier how many shares they had, and that will give you overall gain. Now a question may ask you to calculate gain or loss for the shareholder. It may ask you impact of merger on EPS or MPS. Gain or loss computation for AC and TC shareholder. If you look at the last segment, it says ascertain the profits accruing to the shareholders of both the company. Profits accruing to the shareholder of both the companies. Now, concept is, if problem is silent, you can calculate gain or loss at market price. Sometimes they will specifically ask you to calculate at EPS, sometimes MPS, sometimes problem is silent. It can be at EPS, it can be at MPS, or it can be problem silent. If problem silent, do it on the basis of MPS. For AC, normal value minus normal value into the number of share. For TC, equivalent value minus the normal value into the pre-merger number of share. Into the, it's pre-merger, not post-merger. What you allot is not the important. Pre-merger number of share. Able to understand the concept here? This is called impact on EPS, impact on MPS, change in EPS, change in MPS, impact of merger on or overall gain of the shareholder. Different names can be used. Same format. Particulars, acquiring company shareholders. The name is acquiring company shareholders, target company shareholders, acquiring company shareholders, target company shareholders, post merger MPS or EPS, pre merger MPS or EPS, gain or loss per share, pre-merger number of shares, total gain, pre-merger number of share and total gain. Let's put this now. Impact of merger, impact of merger on EPS, on EPS. Part 2 has asked that, okay. Part 2 has said, what is the change in EPS? What is the change in EPS for whom? Shareholders. It is not the company. It is the shareholders of these people. Particulars and 2 columns. Which is the acquiring company? Rama Limited shareholders. Rama Limited shareholders. Target company, Krishna Limited shareholders. Post merger EPS slash equivalent EPS. One guy normal, another guy equivalent. Post merger earnings per share, equivalent earnings per share. Today itself, the major chunk of the chapter will get over. Anyway, a lot of questions I have to do. But today, I think already I feel 50% of the chapter is over. These concepts are what this chapter is all about. Post merger EPS or equivalent EPS. What is the post merger EPS we had? Right, 2.83. Other side, 2.83 into 1 by 1. 1:1. I want you to specifically write 1 by 1 so that your mind will be clear that you have to do into that ratio. 2.83 less pre-merger EPS. Pre-merger EPS. 2.5 and 3.5. Gain loss per share. If post merger is more, gain post merger is less, it is a loss. Gain or loss per share. 0.33 and losses negative 0.67. With this, the question is over, but I'll do overall also. Sometimes overall can be asked, sometimes per share can be asked. They only asked per share here. Only per share is asked, but overall can also be asked in the question. Pre-merger number of share. How many shares were there pre-merger? 4 lakh and 2 lakh. Multiply. Overall gain, loss. Once you do, I'll explain one more thing here. 1 lakh 32,000. Loss of 1 lakh 34. In fact, if I had done more decimal, gain and loss would have matched exactly. Reason is, at an EPS level, there's no synergy gain. At an EPS level, so one party has to gain, other party has to lose the same amount. One party has to gain, other party has to lose exactly the same amount. Gain of one party is loss of other party. At MPS level, both can gain because of valuation gain. Because of valuation gain. Any doubts on this? Any doubts on the table here? One party is gaining 132, another party is losing 132. That difference is rounding off because we did 2 decimal. You increase the number of decimal, it would have been 0.3333 and this would have been 0.6666. Both the numbers would have matched. Any doubts on this? Can we proceed? Clear. Next. Impact of merger on MPS. Ideal merger is one where at MPS both have to gain. EPS one gain, one loss can happen. EPS people are not bothered. The botheration is always at a MPS level. Both the party has to gain at MPS. If they are not gaining, merger will fail. Merger will fail. Impact of merger on MPS. Same table. Wherever you see the word EPS, change it as MPS first. Change the word EPS as MPS. Change the word EPS as MPS. Initial questions, I'm going extremely slow, but still, if there are still doubts, you'll have to ask me. Post-merger MPS and equivalent MPS. What is the post-merger market price? 39.62. Other side 39.62 into 1 by 1. 39.62. Both are 39.62. What is the pre-merger price? 35. 35. Both are gaining 4.62. 4.62. Both the parties are very happy. Both are gaining 4.62 and 4.62. 4 lakh shares. 2 lakh shares. This is a good merger. This is a good merger. Both the parties are gaining. 18 lakh 48,000 and put together what is the gain? Can you tell me the total? 2772. Any doubts till this? This is what you will see in the table. 140 plus 7210 plus that whatever number you said 27 will be 237.72. Will be 237.72. The overall gain is 27 lakh 72,000. 140 plus 70 is 2 crore 10 lakh. Whereas we got 2 crore 37.72. The gap is the overall gain of the merger, which Rama Limited took away 1848, Krishna Limited took away 9 lakh 24,000. This is what was the split of the gain. What is split of the gain? Any doubts on the concept here? Any doubts on the concept? Major chunk of the concepts are done. So I may have to calculate impact of merger on MPS, on EPS. I can do sometimes at a per share level. Only at a per share level you want, you can do at a per share level. Overall, you want to do number of shares multiplication. Question had asked for ascertain the profits accruing. Normally, we will do it at MPS level. Normally, we'll do it at MPS. So, impact on EPS per share. With this also, it is sufficient. I've done the entire calculation. At a per share is okay. Overall calculation. Any doubts on this? Any doubts on this? Not discussed. Only one main concept is how is this exchange ratio calculated? Because till now question said 0.5 is to 1, 1 is to 2, 1 is to 1. That was simpler. But there can be a question where ICI will ask you to calculate the exchange ratio, and then you have to do the problem. You have to calculate the exchange ratio and then do the problem. Now, what is the logic we will do is, I have acquiring company, I have target company. I can decide anything as a basis, a logical reason. A logical can be a basis which I decide, and accordingly I'll calculate the exchange ratio. What can be a logical basis? Let's assume EPS 10, 5. These are the EPS of two company. If EPS is the basis, is acquiring company stronger or target company stronger here? Acquiring company is stronger. If I am stronger, exchange ratio ultimately will become less than 1. And if you are stronger, exchange ratio will ultimately become greater than 1. You have to write first this value, swap it, and that is the exchange ratio. Swap ratio, swap it. 5 is to 10. Swap ratio, swap it. If EPS is the basis, you say MPS is the basis. 20, 15. 20 and 15. I'm still a stronger company only. Whether I'm a stronger, weaker doesn't matter. I'll have to swap it. Swap it. 15 is to 20. BVPS 25, 45. Swap it. 45 is to 25. In this case, more than 1 because you are a stronger company. You are a stronger. Like this, there can be any basis. One of the bases can be COGS ratio. Just an example, okay? COGS ratio. Now, such basis is not used, but let's understand. COGS ratio. This is 0.40. This is 0.80. 40% and 80%. Basis like COGS is not used, but let's just discuss 0.40 and 0.80. Which is better? 40% better or 80% better? 40% is better. So I am a better company. But if I swap this, and write 0.8 is to 0.4, you have a bad COGS, because of which you are getting more share. This is not logical. This is not logical. So your basis can be two types. One is good variables. Second is bad variables. Good variables do swap. Bad variables write as it is. 0.4, 0.8. Good and bad is not because I am stronger, you are stronger. No, good and bad is the variable as it is. If a variable is a good variable, do swap of the variable. If a variable is a bad variable, example, one question will have NPA ratio. NPA ratio is a bad variable. I have higher NPA, because of which I should not get a higher exchange ratio. So NPA ratio, if at all I'm using, so there will be a question where they'll say GNPA minus 5%. Yours is 40%. Final exchange ratio will be 5 is to 40 only. Will be 5 is to 40. Instead of NPA, capital adequacy ratio. Capital adequacy is a good ratio. Minus 20. Yours is 10. Keep it as 20 is to 10. Keep it as 20 is to 10. Don't swap it. Sorry. Swap it. Sorry. 10 is to 20. Good ratio, swap it. Bad ratio, don't swap it. Bad ratio, don't swap it. How exchange ratios? Find out the basis of the exchange ratio. Find out the basis of the exchange ratio. Basis can be EPS, MPS, BVPS. There can be anything else also. Revenue per employee, overall revenue, whatever is the right basis. Right base value as acquiring company is to target company. Switch those values and take it as exchange Great. Switching is not to be done in case basis is on adverse factors such as NPA cost ratio, such as NPA or cost ratio. Switching is not to be done when it is on the basis of adverse variable. Many students in their mind have decided that adverse means it is good for me, bad for me, nothing like that. On a ratio itself, if somebody says basis is EPS, I want to maximize EPS, good ratio. Somebody says NPS, I want to maximize NPS, good ratio. ROE, I want to maximize ROE, good ratio. Growth rate, I want to maximize growth rate, good ratio. COGS, I want to minimize COGS, bad ratio. NPA, I want to minimize. If it is an adverse factor, don't do switching. Don't do switching. The students think that switching is to be done when it is good for me, switching is not to be done when it's nothing like that. It is on the variable as it is variable. If you have a good EPS, switch it and give more shares to you. If you have a good MPS, switch it and give more shares to you. Switch it and give more shares. Now, in this calculation, when I write the base value, I wrote the base value. Base value was, let's take example, EPS 25. I want to make it as 5 is to 20. Suddenly I become very happy and I say that I will give you extra. I'll give you extra. The question says, I will give you extra on the EPS. That's my wish. I'll give you extra premium. So instead of 5, I want to give extra 50% and make it as 7.5. This is acquiring companies becoming generous and saying, I'll give you extra 50%. I'll adjust your values, adjust base value in case company wants to pay some premium. This is what exchange ratio is all about. Practically, this is what exactly is done to calculate the exchange ratio. Find out the basis, write the base value. In the base value, do any adjustment if needed. What can be the adjustment? I want to give extra to you. I am happy, I want to give extra to you. You take that extra value. The extra value can be on EPS, can be on MPS, can be on BVPS, whatever is the basis. I want to give something extra to you. Consider that extra in the calculation. Switch it. That will become the exchange ratio. If it's a bad variable, don't switch it. If it's a bad variable, a variant of this is called weighted average, which I'll discuss in some time. Example, MPS of company A 50, MPS of company B 20. Company A wants to acquire company B by paying a premium of, I became very happy saying that I'll give you extra 25% by paying a premium of 25%. What is the swap ratio based on what? Base value is 50 is to 20. Ideal scenario, 20 is to ideal scenario. But now I became happy and I said I'll not give 50 is to 20. I'll give you something extra. What is the extra I want to give? So on this 20 rupees, I'll give extra 25%. I'll give extra 25%. So it will become 50 is to 25 and exchange ratio will become 25 is to 50. Able to understand this? This is how exchange ratio is calculated. Practical world, it will not be one basis. It will be something called as weighted average, which we'll discuss in some time. We'll discuss maybe in the next session. We'll discuss today. May not have the time to do that, but this is what the concept is all about. We will decide an exchange ratio. Can be EPS, can be MPS, can be BVPS. This three only I see mostly being there. EPS, MPS, BVPS, and one bank problem is there where there will be an NPA which will come into picture. Any doubts on this? Can we proceed? Okay, let's start discussing this. I have two companies. ABC is planning to acquire XYZ. They've asked for present EPS. The table will give you the EPS. Then they're saying merger goes through. What will be the new EPS? Assuming that merger takes place by way of exchange of equity shares and the exchange ratio is based on the current market price. What will be the exchange ratio if I want to maintain the same EPS, assuming that some conditions they have set in? We'll start doing it. We'll do PAT, number of equity share, EPS, stop at that. I'm not doing beyond EPS. Can I do beyond EPS? Yes, can be done, but I don't find the need to do it in this question. So particulars, two companies merged one and there will be a rework needed in some time. Open ABC, XYZ and merged. A rework will be needed here. Particulars ABC, XYZ and merged. Study material question number 4. There will be a rework needed. I'll explain the rework. Okay. They've asked us to calculate present EPS. The table will give that. What is the new EPS with some exchange ratio given? PAT, number of equity shares, EPS. Beyond this, I don't feel a need to do it. PAT is how much? 50 lakh, 18 lakhs together. Number of equity share, 10 lakh, which is 5, 5 and 3, 5 and 3 below the table. Basis of swap ratio, some basis they have given. What is the basis of swap ratio? Current market price. Could have been EPS also, but they said current market price. Whatever is the basis, the question. It can be EPS, it can be MPS, it can be BVPS. This is what three I see mostly. Okay. Whatever is the basis, write that. Basis is what? Current market price. Base value. What is the current market price of ABC and XYZ? 42 is to 28. Swap ratio, swap it. Two is to 3 or 0.67 is to 1. When I do calculation, I'll do it as 28 by 42 to avoid the rounding off. Okay. The ratio is 28 is to 42. 28 is to 42. Any doubts on this? Clear? Can you proceed? Any doubts on the number here? 28 is to 42. Can we proceed? Clear? So this number is 10 lakh plus 6 lakh into 28 by 42. EPS divide 4.862 decimal. 4.86. Any doubts on this? Clear? Part 1 is done. Present EPS is done. Merger takes place. New EPS is also done. What should be the exchange ratio if XYZ wants to ensure that earnings of the members are same as before the merger takes place? Same as before the merger takes place. Another column. Merged rework. Merged rework. There's a shortcut. I'll explain it, but first let me explain the whole concept. 68 lakh. Who wants the EPS to be maintained? XYZ. What is the EPS of XYZ? 3. If minus 3 today, post merger I don't want 3. Post merger I want my equivalent to be 3. Post merger I want my equivalent to be 3. I don't want mine to be 3. Okay. I want the post merger to be 3, which technically says, listen here, understand very important concept. Now you write all of this, whatever I say. Basis to maintain EPS. Basis to maintain EPS. Check if there is any PAT gain. Check if there is any PAT gain. Is there any PAT gain in this question? No gain. Basis to maintain EPS is equal to exchange ratio on basis of EPS itself. Exchange ratio, once you write this fully, I'll explain. Exchange ratio on basis of EPS itself. Tell me what are the base values of EPS? Exchange ratio will be 3 is to 5. Exchange ratio will be 3 is to 5. I'll explain once you complete this. Okay, understanding will come once we complete this. OR 0.6 is to 1. OR 0.6 is to 1. 3 is to 5 or 0.6 is to 1. Let's go back to the table. I'll be allotting 10 lakh plus 6 lakh into 0.6. 6 lakh into 0.6. I'll be allotting 6 lakh into 0.6. We get how many shares? 13 lakh 60. What will be the EPS? It will not be 3. It will not be 3. I want 5 only. There is I'll explain. Clear? Listen. Now listen. If I get 5, my equivalent is 5 into 3 by 5, which is 3. My equivalent is 5 into 3 by 5, which is 3. So if a question says ABC wants EPS to be maintained, XYZ wants EPS to be maintained, copy paste the 5 as it is as 5. No 3 copy pasting. You cannot copy paste 3. You have to copy paste which number? 5 as it is. ABC wants EPS to be maintained, copy paste 5. XYZ wants EPS to be maintained, copy paste same 5. Because students kept on asking me why it can't be 3 here. It can't be 3. Reason is I don't want 3 as the post merger. I want equivalent 3. I want equivalent 3. What is equivalent? Post merger into the exchange ratio. Now listen, if a question wants EPS to be maintained, no PAT level gain, exchange ratio on the basis of EPS will maintain EPS. Exchange ratio on the basis of EPS will maintain what? EPS. Let's assume a question wants MPS to be maintained. MPS to be maintained. Exchange ratio on the basis of MPS will maintain MPS if two condition: no PAT level gain, no P multiple level gain. No PAT level gain, no P multiple level gain. I'll give you some time to absorb this. Give me 2-3 minutes. Exchange ratio to maintain EPS, MPS, BVPS. You want to maintain EPS, exchange ratio based on EPS only if no PAT synergy. Want to maintain MPS, exchange ratio based on MPS only if no PAT and P multiple synergy. You want to maintain BVPS, exchange ratio based on BVPS only if no revaluation is done. You're acquiring asset and revaluing asset and all, BVPS will change. So to put it very simple, you want to maintain earnings per share. Earnings per share can be maintained if the exchange ratio is on the basis of EPS. Market price has to be maintained. You can maintain market price if the exchange ratio is based on market price per share. Exchange ratio is based on market price per share with two conditions. Okay, condition is there should not be any PAT level gain, there should not be any P multiple. Assuming in this question plus 18 is becoming 75, 80, then you cannot do this shortcut and all. You will have to do the detailed calculation. And in case there is a PAT level gain, they will not say I want EPS to be maintained. They'll give a number saying that I want a EPS of 4, 3, 2, 1, 0, whatever number they are giving. Based on that, you will do the calculation. To put it very simply, EPS to be maintained, do on the basis of EPS. MPS to be maintained, caution note. If the company wants to maintain MPS, we should always try it under table approach, because there will be a valuation gain due to maintenance of P multiple. If P multiple is maintained in a company 10 and 5 continues as 10, there is a P multiple gain. Your mind will not think about it that there is a P multiple gain. So always do the table approach. I have written a caution note. Reason is mistakes are made by students. Mistakes are made by students. I'll explain this again. With this, my main concepts are over. Once this is done, I'll repeat all the concepts. If you want to maintain EPS, exchange ratio on the basis of EPS. You want to maintain MPS, exchange ratio on the basis of MPS. You want to maintain BVPS, exchange ratio on the basis of BVPS. Who wants to maintain? Acquiring company wants to maintain. Doesn't matter. Target company wants to maintain. Doesn't matter. Don't tell me target company wants to maintain, so I'll copy paste 3. No, that will not work. Target company wants to maintain means acquiring company wants to maintain. It means acquiring company wants to maintain, because for target company we have something called as your equivalent number. For this company, we have something called as the normal number. Able to understand this? Any doubts till this? My major chunk of discussion is over. Any doubts on this? Can we proceed? I'll quickly discuss it. I don't think so I'll do any more concepts. Maybe I'll do a problem if needed, but no more concepts. I'll quickly repeat what we have done. We started with understanding what is merger. A merger is an exercise where two companies are joining together. It could be an acquisition, it could be a merger, doesn't really matter. Objective, P and L improvement or P multiple improvement. Either you improve PAT, in our format, improve PAT or improve P multiple. Improvement in PAT, value will go up. Improvement in P multiple, value will go up, because the value is not number of shares into MPS. The value is PAT into P multiple. The value is PAT into P multiple. What is the format we use? EPS, sorry, EAES, number of equity share, EPS, P multiple, MPS, number of equity share, market value of firm. Market value of firm. Just see the concept book 3-4 times till you get full clarity on this. I have full clarity. Any type of question, any order you do, because I'll be in a position to handle the same clarity I want for you. Gain from merger means the post merger value is more than the pre merger value. Why does it occur? Either PAT improves or P multiple improves. The other name for PAT is cash flow. Other name for P multiple is cost of capital. If there is a merger gain given in the question, it mostly means PAT level gain. Mostly means PAT. Question says no merger gain, mostly means no PAT level gain. Valuation gain can still be there because of what item? Because of P multiple. Because of P multiple. Cost of merger. Cost of merger is consideration which you are paying to your target company shareholder. There is a gross cost and there is a net cost. Gross cost, if you do a stock offer, shares issued into the post merger market price. Cash offer, cash paid into number of shares. You will understand question on cash offer as we do. Net cost is gross cost minus whatever was the pre-merger value. This is also called as gain of target company shareholder, and both are fighting as to who will get the gain. That is the objective of this entire exercise. Who takes away the gain? Who takes away the gain depends on exchange ratio. Depends on exchange ratio. Relevant post-merger number. For me, pre number, post number, normal numbers are sufficient. For you, normal number multiplied with the exchange ratio will give me equivalent number. Compare that with the pre-merger number. Gain, loss is calculated. Can be done at an EPS level, can be done at an MPS level. Problem silent, we do it at MPS level. How is the exchange ratio determined? Find out the basis. Basis can be anything, EPS, MPS, BVPS. Write the base value, switch it around, and that is the exchange ratio. That's all. Switch it around, and that is the exchange ratio. Many times ICI will give some formulas. If you have followed some other faculty, there will be a formula. Don't remember any formula. Right? Base value, switch it, and that becomes the exchange ratio. Before you switch, two checks. One, do I want to pay anything extra? Yes, please adjust the base value. Second, is it a good factor or a bad factor? Bad factor, don't do switching. Good factor, do the switching. Gain or loss I have to calculate. Can be done at EPS level, can be done at MPS level, can be called as impact of merger on EPS, impact of merger on MPS. Problem silent, do it at MPS level. Do it at MPS level. How are we going to do? Post merger number, normal number for me, equivalent number for you, minus the pre-merger number, gain or loss per share, pre-merger number of share, overall gain or loss. Two overall gains, overall gain of mine plus overall gain of yours will be the overall valuation gain if you are doing MPS. Overall PAT gain if you are doing EPS. If you are doing the EPS calculation, that is the overall PAT gain, which many question was zero. One company plus another company became zero because there was no PAT level gain. In case a question wants me to maintain EPS, exchange ratio on the basis of EPS. Wants me to maintain MPS, exchange ratio on the basis of MPS. Wants me to maintain BVPS, exchange ratio on the basis of BVPS. Wants me to maintain gross NPA, exchange ratio on the basis of gross NPA. Whatever you want to maintain, please keep that as the exchange ratio. Keep that as the provided. Only one condition is, if it is EPS, no EPS level synergy gain called as PAT gain. If it's MPS, no MPS level synergy gain, which is PAT into PE multiple, PAT into PE multiple. BVPS, no revaluation of assets, no revaluation of liability, no extra asset, no extra liability. Clear, able to understand the concept? Any doubts till this? Any doubts till this? P multiple, price earning multiple, a critical component of a merger exercise. Any merger should ideally revolve around this item called P multiple. Now let's take example what happens in P multiple. Tata and Bharadwaj Institute. Tatas are very well reputed companies in the market. People will give a P multiple of 40 times to Tata. For us, the P multiple is only 10 times. Merger passes through. Once the merger passes through, market may say we want to give same 40 to the merged entity, because people feel it is now not Bharadwaj Institute profits, it is Tata's profit, and they end up giving P multiple of 40. As I have said, value of a company is PAT, 100 into 44,000, 10 into 10, 100, 100 plus 10 is 110, 110 into 40 is 4,400. This is one approach. The one approach is the post-merger P multiple will be equal to the pre-merger P multiple of the acquiring company. This is if problem is silent. If problem is silent. Second thing what can happen is 100, 40, 4,000, 10, 10, 100, 100 plus 10 is 110, 4,000 plus 100 is 4,100. No benefit. No benefit from the merger. 100 plus 10 is 110. 4,000 plus 100 is 4,100. Can you tell me what is this number in between? 37 point. This 37.27 is technically called weighted average P multiple. This is technically called weighted average P multiple. What is weighted averages? I will give a formula, but logic you understand. PAT of acquiring company into the P multiple of acquiring company, PAT of target company into the P multiple of target company, whole divided by combined PAT, acquiring plus target. First scenario, 100 into 40, 4,000, 10 into 10, 100, merge together 110, merge together 40 continuous, merge together 40 continuous. So 110 into 40 is 4,400. This is our usual scenario. Problem silent, pre-merger P multiple will become the post-merger P multiple. Problem silent, pre-merger P multiple will become the post-merger P multiple. Otherwise, there is another possibility which is called weighted average P multiple. Third possibility, 100, 10 put together 150. 100, 10 put together is 150. 40, 10, 4,000, 100, but combined value I want only 4,100. Combined value is only 4. There is a P multiple improvement, but this value continues to be 4,100. Can you tell me what is the balancing figure? 20, 3, 3. Now let's understand these three terms. Problem is silent. Problem is silent equal to pre-merger P multiple of acquiring company. Pre-merger P multiple of acquiring company. It's always acquiring company. There is one problem in ICM, in not ICM material, in one of the exam question where they made it as pre-merger P multiple of target company, just to create a surprise in exam. Weighted average P multiple, PAT of AC into P multiple of AC, PAT of TC into P multiple of TC divided by PAT of AC plus PAT of TC. And the last one is minimum P multiple to justify the merger. This and weighted average P multiple will be same, almost same, unless something like this happen. 100 plus 10 becomes 150. 100 plus 10 has become 150. PAT improves, P multiple deteriorates, overall value remains same. PAT improves, P multiple deteriorates, overall value remain same. This is called minimum P multiple to justify merger. Why it is called minimum is, I will have a merger exercise only if I'm not bothered about PAT, I'm not bothered about P multiple. I'm only bothered about this. 4,000 plus 100 should at least become 4,100. 4,000 plus 100 should at least become 4,100. Otherwise, there is no logic of doing a merger, which is what this formula is. Pre-merger value of AC plus pre-merger value of TC. The numerator here and the numerator here is same only. Pat of AC into P of AC is pre-merger value of acquiring company. Pat of TC into P of TC is pre-merger value of target company. Numerator same. Denominator there is a difference. What is the difference? Pat of AC plus pat of TC. This is post-merger pat which may have some synergy gain. So there are three types of P multiple. I'll explain again. Problem silent equal to pre-merger P multiple of acquiring company. Weighted average P multiple, pat of AC into P multiple of AC, pat of TC into P multiple of TC, whole divided by as of AC and pat of TC. Minimum P multiple to justify the merger, same numerator. Denominator is called combined PAT. Denominator is called combined PAT. Let's see some example. P multiple of A limited 20 times. Number of shares of A limited 1 lakh. PAT of A limited 25 lakh. Number of shares does not matter to us. Okay. PAT is 25 lakh. P multiple of B limited 40 times. Number of shares 50,000. PAT of B limited 50 lakh. What is the weighted average P multiple if the two entities join together? What we do for weighted average? Weighted average P multiple is equal to PAT of AC into P multiple of AC. When I do MCQ, no need to write, be in lesson mode only, understand it properly. PAT of TC into P multiple of TC whole divided by PAT of AC plus PAT of TC whole divided by PAT of AC plus PAT of TC. Now coming to this calculation, PAT of acquiring company in this example is how much? I want participation guys, okay? 25 lakh. P multiple 20 times. PAT of target company 50 lakhs. P multiple 40 whole divided by 25 plus 40 whole divided by 25 plus 40. What's the answer you get? 25, sorry, 25 plus 50, sorry. 33.33 times. 33.33 times. What is minimum P multiple is instead of 25 plus 50, 25 plus 50 plus another 15. There could be some extra here. There could be something extra here. And because of that extra, the P multiple technically can go down little bit. P multiple can go down. P multiple goes down. PAT improves. One offsets the other. 1 minute for you. Answer this. 13th example. Right. Example 13. Try. 1 minute for you. Example 13. Minimum P multiple. I'll wait. I don't want the answer from your side. Just wait for a minute. Let others also complete. A minute we will wait. Live online guys, you can start typing in. In here, I don't want you to tell the answer. Let others complete. Live online guys, you can type it. Okay, if you have done that, also do the weighted average P multiple. Which will have a different denominator. That's all. Weighted average P multiple will have a different denominator, and minimum justified P multiple will have a different denominator. That's the only change. Do both. Okay, I've started getting the answers. I think here also you guys would have completed. What is the P multiple you got? Minimum justified P multiple. 8 times. 8 times and weighted averages, I think 8.333. What is the calculation? PAT. What is the PAT of the first company? 20 into 10 plus 40 into 7.5 whole divided by 20 plus 40 plus 2.5. Without 2.5 addition is called weighted average P multiple. With 2.5 addition is called minimum P multiple to justify the merger. Any doubts on this? Clear? Understood this? So this is one approach on P multiple part, an extremely important approach to do the valuation of the merged entity. Can we proceed? Clear? Okay. Now I'm doing a merger exercise. When I do a merger exercise, one of the important things we do is we value the post merger company. Our approach is this most of the time. Post merger PAT into the P multiple. Post merger PAT multiplied with the P multiple. Most of the time this is the formula we use. But there's also an approach to which some rare scenario we will use it. What is the approach to? You have acquiring company value pre-merger. You have target company value pre-merger. Unfortunately, this formula is not possible in the question. With that, there will be something called as a valuation gain. What is valuation gain? The benefit which comes out of the merger could be 100 lakh, 200 lakh, 500 lakh, 1000 lakh, whatever number. That valuation gain either is given in the question or we compute using some calculation, and the sum of the three is the post merger value. The sum of the three is the post merger value. What are the three items? Pre merger value of acquiring company, pre merger value of target company, plus the valuation gain. The same is also this also. Technically this also is the same thing, because I used to call, we get the answer, but the component of that were three parts: pre-merger value of acquiring company, pre-merger value of target company, and the balancing figure was called gain from the merger, or technically valuation gain of the merger. Any doubts on this? Any doubts on this part? Give me answer to 11. It is there in front of you in the screen. There's no major calculation. 30 seconds time. I've not even shown the option, but it's a 30-second discussion. What are we planning to maintain? EPS. If EPS is to be maintained, exchange ratio on the basis of EPS. What are the base values? 10 is to 20. Swap it, you get 20 is to 10, or technically 2 is to 1. Clear? Any doubts on this? Okay. Pre-merger MPS of A Limited 100. Pre-merger MPS of B Limited 200. A is acquiring B Limited, and post-merger I expect the value to be how much? 150. Exchange ratio is 2 is to 1. What is the gain or loss per share for A Limited shareholder and B Limited shareholder? MCQs are the excellent way to test everything. Here, post merger value is 150 for me. For you, it is 300. Why 300? Into 2 by 1. For you, it is 300. For me, it is 150. Pre-merger values 100, 200. I gain 50 rupees, you gain 100 rupees. I gain 50 rupees, you are gaining 100 rupees. Because for you, what is the logic? Equivalent value. For me, the normal value. For me, normal. What is equivalent value? Multiply with the exchange ratio. So gain of 50 and gain of 100. Any doubts on this? Give me answer to this. Question 9. a 1 minute discussion maybe. Some of you would have completed. If you have completed in physical class, I don't want you to tell the answer till I ask you, because others will complete. Live online, guys, you can start typing it. Okay. I think almost got the answer here. What's the answer, guys? No gain, no loss. The post merger EPS is how much? 25. The merger will be done 4 lakh is to 10 lakh. 4 lakh is to 10 lakh into 4 by 10. Equivalent is 10, and pre-merger is 10. No gain, no loss. Now when you do a bigger problem, calculating this 25 takes time, but the concept was only this. Calculating 25 will take time. In MCQ, I didn't want to spend time on all of that. That is where MCQ makes it quicker for us to understand any concept. Give me answer to this. Question 7. 30 seconds. It's a 30-second discussion question. Live online, guys, you can type it. Answer is 20, no? 40 into 1 by 2. 40 into 1 by 2. It's the swap ratio directly 1 by 2. 40 into 1 by 2. Answer is 20. If the base values are 1 by 2, exchange ratio would have become 2 is to 1. Any doubts on this? Okay. This could be little challenging. I'll take you through. Value of acquiring company 1000. Value of target company 600. Merged entity 2000. Number of shares in both the companies are same, and exchange ratio offered is 1 is to 2. How much is the NPV of the stock offer? NPV means my gain. Net cost of merger is your gain. You are the target company. I am the acquiring company. In this merger, first tell me what is the overall gain we are making. What is the overall gain we are making? 400 lakh. Now, only thing I need to decide is how much you will take, how much am I going to take. Post merger, the value is, in this 2000, I will have some share. You will have some share. The question has not talked about number of shares in the question, but only thing I know is number of shares in both the companies are, so let's assume I had 100 share. My 100 will continue to be 100. My 100 will continue to be 100. I am the acquiring company shareholder. My 100 cannot change. You had 100 share. Your 100 will become what? 50. So this 2000, 100 parts for me, 50 parts for you, because you had 100 share. I also had 100 share. What did I do in the merger? I gave you 1 is to 2. Only question said number of shares in both the companies are same. So can you split 2000 in the ratio of 100 is to 50? I think it will be 1000. So my 1000 became 1333. I gained 333. That is my NPV. Your 600 became 667. You earn 67. You earn 67. That called net cost of merger. Your gain is 67. My gain is 333. Able to understand the concept here? Any doubts in this? Number of shares were not given. So I, if I want, I can calculate per share price and do all that calculation. But net the gain is, my gain is 333. Your gain is 67. Any doubts on this? Let's come to 5. Value of acquiring company 540 lakhs. Value of target company 90 lakh. Synergy gain from merger 45 lakh. Number of shares of A Limited 30 lakh. Number of shares of B Limited 18 lakh. Exchange ratio is 1 is to 3. How much is the consideration paid? Formula for consideration paid is this: number of shares issued into post merger market price per share. Number of shares issued into post merger market price per share. In this example, can you tell me how many shares are issued? 6 lakh, very simple. 18 lakh shares were there, 1 is to 3. 18 lakh shares were there, 1 is to 3. I have allotted 6 lakh share. How will I calculate post merger market price? I've already explained you. How will I calculate post merger market price here? Formula 2. Formula 2. What is formula 2? My pre-merger value, your pre-merger value, and synergy gain from merger. And synergy gain from merger. This is valuation gain directly, not pat level. Because I cannot do any pat level analysis here. I cannot do any pat level analysis in this question. In this question alone, this is one exception. One exception where I have told earlier also, gain from merger would normally mean your pat level gain. But this alone is what? Directly the valuation gain. Directly the valuation gain. So post merger, the value is 540 plus 90 divided by 30 plus 6 into 6 into what is into 6 is to calculate the consideration paid. To calculate the, can you quickly give me the answer? Any doubts on this? Like this, if you keep practicing the MCQs, most of the concepts will get clear. One thing you can do is, any chapter you take, once all concepts are done, it will be easy for you to go through all the MCQs, because some interlinkages will be there, some of the concept. I would want to obviously keep it below the concept, but sometimes interlinkages will be there. You will find some MCQs little tricky, but once all are done, any MCQ you can handle in that chapter. So ideally mutual funds, except for that last 6 areas, everything else should have been possible for you to handle. Any doubts till this? Clear? Let's do few questions and then I'll come back to 11 concept in some time. Let's do 12. Decision on sale of share. Now, what is decision on sale of share is, I have planned to acquire your company and you as a shareholder is not liking this merger. You did not want this merger to happen itself. I explained you, I told you, then voting happened in the board meeting, whatever, in the general meeting. There will be some percentage which is needed. So good percentage of people voted for it, merger passed through, but you are unhappy about it. You are unhappy about it. So now you are deciding whether you want to sell the share. Two things can happen in a question. A question may give something called as an opportunity cost of capital or without opportunity cost. Ideal approach is this. This is a very logical approach. I don't know why this was given itself, but the most logical approach is the second one. Opportunity cost of capital not given. If it is not given, very simple. I will, a merger started, okay? A merger was happening, price is 20. Suddenly, because of the merger announcement, it has become now 25. 20 has already become 25. I'm already sitting at a gain. And post merger, my equivalent market price will be 30. Post merger, the equivalent, what is equivalent? Post merger market price into the exchange ratio. If this is the scenario, you were at 20, 20 has already become 25, be happy about it. Also be happy, wait, 25, let it become 30 and then sell your share, so the logic is, compare pre-merger market price with post-merger equivalent market price. If you are going to make a gain at the market price level, continue with the share. If you are going to have a loss at the market price level, sell your share. Gain, you continue, loss, you sell it. I'll come to opportunity cost of capital part in a minute, but more logical is this. More logical is this. Okay, you have to answer this. Question 16. Question 16. You answer this. Question 16. You already know the approach. I'll anyway discuss it in a minute. 16th question. I've started getting answers in live online. Can you tell me the answer? Okay. Post merger, the equivalent number is 31.3 into 0.5. Pre-merger, the number is 14. Post-merger, I think some 15 point something you get. Pre-merger is 14. Wait, accept the offer, get your shares converted. After that, you don't like the company, sell it. After that, you don't like it, sell it. He should accept the offer. Any doubts in this? Clear? Understood this? This is what is discussed in question 14. I'm not going to do it. Question 14, you know how to work with this table. And the last part was this. If you are the shareholder of T Limited and holding 100 shares, will you be interested to sell the stake? What is that calculation you are going to do? Exactly the same numbers. The numbers are copied from here only. The numbers is pre-merger 14 rupees. Post-merger you will get 31 rupees. You know how to calculate 31 and all. You'll have to put it in the table format. Get to the answer. So question 14 is done. Technically everything same. Extra add-on was this item called as decision on sale of share. This is one approach. I feel very logical approach is this, but ICI, I don't know, has given one more approach also. This came in November 22 exam. Another approach came in some other exam. Any doubts on this first? Any doubts on this? Another approach is if you have something called as opportunity cost of capital. Now, what is this opportunity cost of capital? Let's understand. Today, share price is 20. Merger got announced. Share price started reacting. It became 24. Post merger, it will become something, but they say don't analyze that. Don't get into that analysis itself. You are not going to do it at a market price level. 20 has already become 24. Now, if I sell today, invest this 24 somewhere else. Where can I invest? Any other place. That place will give me 24 into 10%. That place will give me 24 into 10% wherever I invest this, which is 2 rupees 40 paise. If you wait, you will become part of the next company. In the next company, after 1 year, they say you should at least earn 2.4. You should at least earn 2.4. This is the logic they have built in the calculation. You are at 20 today. 20 is becoming 24. 10%. 10% is what you want to earn, 2.4. What you earn in the other company is called equivalent EPS. What you earn. Why equivalent? Because you will not get the whole EPS. You will not get the whole EPS. So in the other entity, I will be earning 1.8. They say no, 1.8 is bad. Don't do it. 1.8 is bad. You should earn how much at least? 2.4. This, instead of giving 1.8, 2.4, they introduced a formula. What is the formula? Earnings yield. Earnings yield. You will learn about this in the ratio analysis. What is earnings yield? Is EPS by MPS 1.8 equivalent. MPS today is 24. Can you tell me this number? I'll explain this example again. First tell me the number. 1.8 by 24 into 100. Into 100. Into 100. You are going to earn 7.5% from this company. Go ahead and sell and earn 10% from the other company. 10% from the other company. I'll explain again. Price is 20 today. 20 will become 24. Has already become 24. Somewhere else I can earn 10%. If I stay with this company, I will earn this. Equivalent EPS divided by the pre-merger MPS of the target company. This is what I will earn. This is what I will earn if I sit back for one more year. If I sit back for one more year, calculate earning yield and compare with opportunity cost of capital. Earning yield more than the cost of capital, very happy. Earning yield more than the cost of capital, extremely happy. I wanted 10%, you are giving me 15%, extremely happy. Continue with the company. Only logic I'm not okay with this is the earnings will not come fully to you. The earnings will not come fully to you because from the earnings you will get only dividends. So that is why I was not okay with the logic. But in case they give opportunity cost of capital, this is what ICI has done. We will do one example and then I go to the question. A Limited is planning to acquire B Limited. Current price is 10. Same got increased by 20% on merger announcement. Same got increased by 20% on merger announcement. So 10 has already become what? 12. The post merger EPS and MPS will be 2 and 25. I will not get 2 and 25. I will get only equivalent number. I will get only equivalent number. Exchange ratio offered is how much? 0.8 is to 1. Can you tell me what is the equivalent EPS? 2 into 0.8. So I will be getting 1.6. Can you tell me EPS? I had asked, friends. EPS is 1.6. 2 and 25 equivalent number is 1.6. 1.6 on 12 is how much? 1.6 on 12 into 100 into 100. 13 point. If you go through the equivalent MPS logic, this is a very good merger. Why equivalent MPS logic? Very good merger. 25 will be the price. 25 into 0.8 is 20. You are at 10. Already reached 12. Why don't you wait for some more time and take 20 and move out? Take 20 and move. But they are not doing that comparison. They are doing a comparison at an earnings yield level. Because why? There is another opportunity with how much? 12%. This is giving how much? Good exercise. Continue with the company. Good exercise. Continue with the company. But for me, more logical approach is equivalent MPS. Gain at MPS level, loss at MPS level. That is what is very, very critical. But in case opportunity cost is given, ICI will do this. 2 into 0.8 by 12 into 100, 13.33%. Earnings yield is better than the alternative investment opportunity. Hence, Mr. X should accept the merger offer. Able to understand this? Any doubts on this? I'll repeat again. In case earnings yield is given, in case opportunity cost is given, calculate earning yield. What is earning yield? Equivalent EPS. Why equivalent? That is what I will get, divided by today's expanded share price. Expanded is it's already would have gone up. It could have already gone up. Consider that higher price in the calculation. Clear? Able to understand this? Okay. Now, next concept I want to explain is value of original company shareholders. Let's understand the concept. We are doing a merger exercise with one belief. The belief is that 210 plus 31 will become 255, 256, 270, 280, 290. It will go up. But there is a possibility that the merger happened and post-merger no benefits came in. Post-merger no benefits came in. It is a possible exercise. So what is value of original shareholder is, you had a company, 100 shares were there, value is 6,000, okay. 20 shares are there, value is 1,000. Put together, this became 125. I allotted 25 shares. I expect 6,000 plus 1,000 will become 8, 9, 10, 11. But in reality, it became only 7,000. No benefits came from the merger. What is value of original shareholder is, in this 7,000, split in the ratio of 100 is to 25. 100 is to 25. Logic is very simple. Merger passed through. But merger did not give any gain. If it does not give any gain, maybe one party gains, another party loses, or both have no profit, no loss. What is value of original shareholder is post merger value of AC and TC shareholders, assuming no gain in merger, assuming no gain. There's a formula, understand logic only. Pre merger value of AC plus pre merger value of TC, no gain, no gain, divided by pre merger shares plus the shares issued, multiply with AC shareholders, TC shareholders. No benefit from the merger exercise. No benefit from the merger exercise. Can this happen? Yes, can happen. Merger may fail and it can be a negative benefit also. But here we are doing zero benefit from the merger. Zero benefit from the merger. A small example. Number of shares of A Limited 20 lakh. Number of shares issued to B Limited is 10 lakh. I have 20 lakh. I am issuing 10 lakh to you. My old value is, your old value is 50. Put together the value will be 300. No benefit. 300. In this 300, I will be holding 20. You will be holding 10. So my value from 250 will go down to 200. Your value from 50 will go up to 100. That is called value of original shareholder. Value of original shareholder means no benefit is going to come from the merger exercise. In such a scenario, both the parties can have no gain, no loss, or one can gain at the expense of the other. One can gain. So split that formula and all, very lengthy formula I've written, but just understand the logic. Add up the values and split in the ratio of my shares, no change. Your shares, whatever I'm issuing it to. Your shares, whatever I am issuing it to. Clear? Able to understand this? Any doubts on this? Okay. Now comes another important area, which is called minimum exchange ratio and maximum exchange ratio. Minimum and maximum exchange ratio. Let's understand this fully and then we start doing questions around it. Exchange ratio, if basis is not given in the problem. I don't tell EPS, I don't tell MPS, I don't tell BVPS, no basis is given. But still I tell you, do an exchange ratio. If problem is silent, we will do two exchange ratio. One is called minimum exchange ratio. Second is called maximum exchange ratio. Minimum is from your point of view. Maximum is from my point of view. Maximum is from my point of view. In any transaction, in a practical world, let's assume I want to sell this building. When I want to sell this building, a seller, I am the seller or you are the seller. You are the seller. In your mind, you have in mind that at least I need 10 crores from this property. In my mind, I will pay maximum 15 crores for this property. I am the buyer. Maximum I will pay 15 crores. You are the seller. Minimum you need 10 crores. You need 10 crore. You may quote 18, 20, whatever. I want to pay maximum 15. I may quote 5, 6, 7, 8. We negotiate and then decide the price. So in any transaction, the buyer has some number in his mind. The seller has some number in his mind, which is called minimum number and a maximum number. You are going to at least need something. What you need is consideration paid is equal to pre-merger value of target company. What is pre-merger value of target company? Today your company value is 10,000 crore. In the merger, at least I need to pay you 10,000 crore. That is in your mind. That is in your mind. At least 10,000 crore you want. So let's assume a merger is happening. First company value is 15,000 crore. Your value is 10,000. Put together is 40,000. Your mind is you want this. What I can afford to pay you is my value today is 15,000. Post merger, my entire entity will become 40,000. Extra I get is 25,000. I can give this 25,000 to you. I can give this 20. In the post merger entity, 40,000 is there. I want 15,000 only. I'll give you 25,000 maximum. I'm talking about maximum. You are wanting only 10,000. If I fix between 10 and 25, both the parties will be happy. If you fix outside the limit, merger will not pass through. Merger will not pass through. So logic is minimum exchange ratio from target company point of view, ER at which consideration paid is equal to pre-merger value of target company. Maximum ER from my point of view, post merger value minus my own pre-merger value, this is how we will decide the consideration and we will decide the exchange ratio. A small example: value of acquiring company 1000 lakh, value of target company 500 lakh. How many shares are there? 10 lakh shares are there. How many shares are there? 50 lakh. Merger gain is 500. What is the acceptable minimum and maximum exchange ratio? Acceptable minimum and maximum exchange ratio. Example 14, very good example to understand the concept. Now listen, I have an acquiring company, I have a target company, I have a merged company. Acquiring company today has 10 lakh shares, value is 100,000 lakh. Other entity has 50 lakh share, 10 500 lakh. Can you tell me first what will be the merged entity value? 1000 plus 500 plus another 500 plus another 500, 2000. We are not sure on this part. What is this part? Is how many shares will be there after merger, because basis is not given. What is the consideration you want? What is the minimum consideration you want? 500. What is the maximum consideration I can give? 1000. 2000 minus 1000. So let's first do the minimum analysis. In minimum analysis, overall value is 2000. You want 500. I want 1500. I want the balance. Balance will be mine. Balance will be, you want only 500. Balance is 1500. This 1500 is equal to 10 lakh share. My number of shares can't change. I'm an AC shareholder. My number of shares can't change. 1500 is equal to 10 lakh. Can you tell me 500 will be equal to what? 3 lakh. So in the merger, I'll give you 3,33,333 share. In the merger, I'll give you how many shares? 3,33,333 share. Exchange ratio is 3,33,333 is to 50 lakh. That is the exchange ratio. Exchange ratio is 3,33,333 is to 50 lakh. I'll explain again. My value is 1000. Your value is 500. Combined value is 2000. I asked you how much you want. Minimum in your mind is 500. Minimum in your mind is 500. So out of the 2000, my value 1500, your value 500, my 1500 is 10 lakh share, your 500 is 3 lakh share. What is maximum? Same 2000. Now I'm happy and saying I'll give you 1000. I'm happy and saying I'll give you 1000 minus balance 1000. This is equal to, you will also be getting 10 lakh share. You will also be getting 10 lakh share. So I can give you 3 lakh share. I can give you 10 lakh share. A good merger is 5, 6, 4, 5, some number in between. You are also happy. I'm also happy. You are also happy. And I'm also happy in case I fix a number in between. So see here, we will allot 3,33,333, which is ER of 0.0667 is to 1. Or I'll be allotting 10 lakh, which is an ER of 0.2 is to 1. Excellent example. You are happy with your own pre-merger value. I am happy to give you maximum, okay? Maximum I can give you is post-merger value minus the pre-merger value of my own company. The number of shares, how will I calculate? Whatever I give you is question mark. Balance is my value, which is equal to my own shares. My own shares can't change. Any doubts on this? Can we proceed? Able to understand this? Clear? Next comes the concept of post-merger EPS. Guys, done with the previous question. I want you to focus now on this. In case you want me to wait, let me know. Can we live online, guys? Anybody needs time? Can we proceed? Clear? Okay. Now coming to the post. Okay, 2 minutes a student has asked. I'll wait for a minute. Wait for a minute. Okay. Post merger EPS, which we calculate. One, there is a stock offer. Stock offer means I give you shares. Simple. Post merger PAT divided by shares of AC plus shares issued to TC. There's another way of acquisition which is called cash offer. In a cash offer, I'm not going to give you any shares. I'm not going to give you any shares. So let's assume AC is there, TC is there, PAT is 100, 10 lakh shares, 10 is the EPS. You are at 200, again 10 share, 20. Post merger, 10 plus 10 will become only 10. 10 plus 10 will become only 10. I'm not going to allot any shares to you. I'm not going to allot any shares to you. Logically, 100 plus 200, if it becomes 300, I'll be very, very happy. Because 100 plus 200, if it becomes 300, then extremely happy because my EPS will shoot up. If EPS shoots up, P multiple remains same, price will go up significantly in the market. So ideally, 100 plus 200 can't become 300. So whenever you acquire a company through a cash consideration, the post merger PAT is 100, correct, 200, correct, but there will be one subtraction. One item will get subtracted here. What is that subtraction? 100 synergy gain and all can also come. Plus can be anything. To acquire you, I have paid you 2000 lakhs. I paid you 2000 lakh rupees to acquire your company. Where will this money come from? This money has to come from some source. It could be that I take a loan and acquire your company. Practical world, I can take a loan and acquire your company. If that happens, 100 plus 200 subtract after tax interest cost. Why after tax? Because we are doing at a PAT level. If you do at a PBT level, subtract normal interest cost, then deduct tax, get PAT. So I have to subtract what? After tax interest cost, because on this 2000 lakh, I have to pay an after tax interest of 200 lakhs or 100 lakhs or 150 lakhs or 160 lakhs, some number I have to pay, because obviously I have to take a loan and acquire your company. Other thing could be that I already had money. I already had money. In that case, that money was earning me something, because I will not keep it idle. No, that money was in some fixed deposit or some mutual fund or something. So either you will have after tax interest cost real or notional. Notional means opportunity cost. What is opportunity cost? You were earlier earning, but now you will stop earning that income. You were earlier earning that income, now you will stop earning that income. So minus loss in interest income or minus real interest paid. What is loss in interest income? This part of AC, no, already had that interest income. That income will go off now. That income will get removed from your company. So PAT of AC will go down, TC PAT will get added, combined PAT overall may go up, may go down, I don't know, that we'll have to do the calculation. But denominator very clear, only shares of AC, only shares of AC. Able to understand this? Any doubts on this? Earnings of a target company 75 lakh. Earnings of a target company is 75 lakh. Acquiring company plans to give cash consideration, which will be funded with a 15% loan. I'll take a loan, 15% interest. Tax rate is, which means after taxes, 10.5%. How much is the maximum consideration payable, so that overall EPS of the acquiring companies maintain. Overall EPS of the acquiring companies maintain. Let's understand this now. I want to acquire your company. My company had 1000. Your company is at 75. My company had 100. Your company had whatever number of shares. That's okay. Put together 100 plus this will be 100. EPS earlier was 10. I want same 10 to be maintained. This is possible if same 1000 is maintained. How can you maintain same 1000? 1000 plus 75 after tax tax interest cost after tax interest cost should be equal to what? Earnings of the target company should be equal to earnings of the target company, or another logic is take a loan, pay that loan through the earnings of the other company. Take a loan and pay that loan through what? Earnings of the other company. You are acquiring a company, no? That company will give you earnings. Use that earning and repay the loan. Repay the loan. This is the logic. If your earnings take care of exact interest after tax, exactly takes care, additional profit is zero. Additional profit is zero. Additional shares is zero. Additional EPS is zero. Additional EPS is zero. I'll explain again. I don't know value of my company. I don't know PAT of my company. Doesn't really matter. My PAT will not change. My number of shares will not change. My EPS will not change. If EPS was to change, question can say EPS has to change. Then I need my company data, the EPS data. Balancing figure will be the after tax interest cost. Balancing figure will be the after tax interest cost. So in this case, 75 lakh is equal to 10.5% of loan after tax. 75 lakh is equal to 10.5% of the loan. 10.5% after tax. Can you divide 75 lakh by 10.5%? I can afford to pay you 714.29. I can afford to pay you 714.29. I'll explain again. You are going to give me 75 lakh rupees. What will I do? 714.29 into 15% I'll have to pay. Some 107. Income tax guy says this is a tax deductible expense. If it's a tax deductible expense, I'll get 30% benefit there into 0.7, which is 75 lakh. 75 lakh interest to be paid, 75 lakh profits will come. Profits meet the interest. No extra profit for me, no extra shares for me, no extra EPS for me. Clear? Able to understand this? So if you do a cash consideration, what is going to happen is total PAT will be earlier PAT plus the new PAT, that is AC PAT plus TC PAT plus synergy gain. If there's a synergy gain, add that, minus after tax interest cost. What is that after tax interest cost? Two types. One type is called opportunity cost, which is called loss in interest income. Second type is called real cost, which is interest paid, Clear? Any doubts on this? Able to understand this? Can we proceed? Okay, let's keep doing few questions and I'll come back to concepts. Question 22. Long Limited is planning to acquire Tall Limited with the following data available for both the companies: expected EPS, expected dividend per share, number of shares, current market price per share. As per an estimate, Tall Limited will have a steady growth rate of earnings and dividend to the tune of 6% per annum. Under the new management, growth rate will be enhanced to 8% per annum without additional investment. Sorry guys, sorry. I've unmuted. I was just reading the question. I've unmuted. I was just reading the question. Without the additional investment, you are required to calculate the net cost of acquisition by Long Limited if 60 is paid for each share of Tall Limited. If the agreed exchange ratio is 1 share of Long Limited for every 3 shares in lieu of the cash consideration, what will be the net cost and gain from acquisition? Go through the question and then I'll start explaining. You go through the question first. Okay, let's understand this, and there's a concept which also needs to be explained here. Net cost of acquisition means net cost of merger. What is net cost of merger? Is gross cost minus your pre-merger value. Gross cost minus your pre-merger value. Part 1 is fairly simple. I am going to pay how much? 60 rupees cash consideration. It is a cash consideration. Agreed exchange ratio is 1 share for every 3 share in lieu of cash consideration. I don't go through cash consideration, then I go through share consideration. Cash consideration, very simple calculation. Cash consideration paid is cash paid into number of shares. Shares consideration, the headache is I need post-merger market price. In this question, today the growth rate is 6%. Later the growth rate will increase to 8%. Now, how do I factor this? This can be factored through Gordon's formula. I'll explain the concept and then come back to the question. Impact of revision in growth rate. Impact of revision in growth rate on value of firm. Value of target company's business will increase. Value of target company's business will increase in case there is a revision in growth rate. Cash flows of company A 40 lakh. Expected cash flows of company B for next year is 80 lakh. Valuation of company B today is 800 lakh and company B is likely to grow at 10%. Post merger, company B will grow at 15%. What should be the revised value for business of company B? Whenever growth changes, stock market likes such company a lot, growth increases, value will increase. What is the value of the target company business today? 800. Now, what is value is very simple. KE is equal to D1 by P naught plus growth rate. D1 by P naught plus growth rate. Or I can say K is equal to overall dividend, overall value plus growth rate. Overall dividend means overall all shares put together. Overall value means all shares put together plus growth. Dividend is proxy for dividend is cash flow. How much is the cash flow the business is generating today? Next, other company. Our company no change. Other company is what we are analyzing. My company cash flow is 40 lakh, zero implication in the calculation. Cash flows of the other company is 80 lakh. Valuation of the other company is 800 lakh. So other company is 80 by 800 and growth rate is 10%. Growth rate is 10%. So the cost of equity today is 0.20. Benefit is this 10 will change now as 15. Just because growth is changing, KE cannot change. KE is basically the risk expectation. So I expected this company to give me 20% return. The business which was happening, we wanted 20% return from that business. Earlier it was growing at 10%. Now suddenly it grows at 15, 16, 17, 18, 19. When growth increases, we may think KE will increase. No, KE will not increase. D1 by P naught will change. The D1 by P naught number will change. I'll explain again. Today 80 lakh cash flow, 800 lakh value, 10% growth. Tomorrow K is equal to dividend value plus growth rate. If risk is not changing, this continues to be 0.20. There is no change in risk. Question is not talking about any change in risk. Next year cash flow also no change. They have told only 80 lakh. Next year cash flow is 80 lakh. Value is balancing figure. Growth is now 15. No? Growth is 15%. Growth is 15%. I take 15 to the other side. 0.20 minus 0.15 is equal to 80 by value. Can you tell me the value? 1600. Huge improvement in the value. 800 lakh value is becoming 1600 lakh. Does this happen in the practical world? Yes, it happens in the practical world. If you are a high growth company, market gives a significantly higher value. Market gives a significantly higher value if you are a high growth company. Any high growth company will have a significantly higher value. Will have a significantly higher value. So what will happen now is 80 divided by the value will now become 1600. Value will become 1600. Able to understand this? Any change in growth rate of a company, impact of that can only be analyzed through this. Impact of that can only be analyzed through Gordon's formula. What is Gordon's formula? K is equal to overall dividend by overall value plus growth rate. Again overall dividend, but now value is the balancing figure. Value is the balance. Can KE change? Yes, if they given the question. They can say after merger, the KE will increase, decrease. If they mention, I'll take it. I have no problem with that. Clear? Now coming back to this question, one approach we normally do is pat into P multiple. This question, no pat into P multiple. Pat into P multiple cannot give effect to the change in growth rate. Pat into P multiple approach cannot give effect to the change in growth rate. So post merger values, long limited today's value plus tall limited's revised value. What is tall limited's revised value? Using the formula which I said. I will be doing that calculation and calculate tall limited's revised value. How will you calculate? Existing KE. Use the existing KE. Value is balancing figure. Some increase will happen in the value. That is technically the gain from merger. That is technically the gain from merger. Will anything happen to long limited? Nothing is mentioned in the question. So long limited, no change. Tall limited's business value will increase and overall value will go up. Now write first one. Net cost under cash consideration. Net cost is equal to consideration paid minus pre-merger value of target company. Cash consideration is very simple. Consideration paid minus pre-merger value of target company. How much consideration we want to give? 60. How many shares are there? 60 into 18 lakh minus your pre-merger value. What is the market price? 50. Your value is 50. You are target company. I am the acquiring company. Always in our discussion. So your value is 50 into 18 lakh. I am giving you something extra. That extra is called net cost of merger. Cash consideration, very simple. 60 into 18 lakh minus 50 into 18 lakh. How much extra we are giving? 1 crore. Clear? Headache is with the second part. Second part said exchange ratio is 1 share of long limited for every 3 shares of tall limited in lieu of the cash acquisition as in 1. What will be the net cost? Net cost is first gross cost. What is gross cost? Consideration paid. What is consideration paid? Number of shares issued into post merger market price. How do I get post merger market price? We'll have to do the calculation. Pat into P multiple approach will not work in this question. Students have asked me, why can't I do pat into P multiple? It can't give effect to the change in growth rate. That information is not there. Change in growth rate. Do pat into P multiple. No problem with that. No problem with pat into P multiple. Next, the second scenario. Particulars long, all and merged. Only 3 items. MPS, number of share and value. MPS, number of share and value. MPS, number of share and value. Other things will not serve any purpose here, okay? EPS, P multiple, if you want, you write it, but it doesn't serve any purpose. EPS into P multiple cannot be done here to calculate the post company value. Which formula will be using? There was a formula 2. Value of first company, value of second company plus synergy gain computed are given in the question. You have to compute it here. You have to compute it here. What is the MPS of the first company? 180. How many shares are there? 30 lakh, 5,400. I'm doing it in lakhs. 180 into 30. Second company, how many shares? What is the price? 50, 18, 900. What is the exchange ratio we have decided? 1:3. So 30 plus 6, 36. Problem is this. How will you get this? Is 5,400 plus revised business value of tall limited. How will you get revised business value? Existing KE, use the same KE and value will be balancing figure. Value will be balancing figure. Today the value is 900 lakh. The business is having a value of 900. Growth rate, what is today's growth rate? 6. It changes to 8. We did a problem earlier. Example, 10 was becoming 15. Same thing only. There it would have looked very simple to do because I just focused on that aspect. Here too many extra information is there. Now write KO equal to or KE equal to overall dividend, overall D1, overall value. I can do at one share also, but one share some students find it difficult in the revised scenario. So I don't do one share. I do overall itself. Overall dividend, overall value plus growth rate. Overall value is 900. Growth rate is, how much is the growth rate? 0.06. Dividend, something they have mentioned in the question. 3 per share. Expected dividend. Expected is next year dividend is 3. Overall, we are doing overall calculation. Can I do per share also? You can do per share also. You'll get the same answer. Revised, when I do, some students confused them. So I'm not doing per share calculation. 3 into 18 lakh is 54. Tell me the KE. Again, same formula we will use. This formula can give effect to change in growth rate. Can give effect to, whenever you see growth rate in a question, you will have to think about Gordon's formula. This Gordon's formula can take care of the growth rate. This formula you would have learned at inter level also, and if you have gone through security evaluation, you would have learned there. But at inter level, you would have learned K is equal to D1 by P naught plus growth rate. Can I do it for one share? Yes, you can do it for one share. Revised calculation, some students confused. Same formula again. K is equal to overall D1, overall value plus growth rate. Overall D1, overall value plus growth rate. What is the KE we calculated? 0.12. Overall dividend will remain same. Next year dividend is already given in the question, which is how much? 54 lakh. Value is balancing figure. What is the new growth rate? 13. If I want this question to become more complicated, I can give a growth rate for my company also. Change that growth rate. That will obviously lead to different value for my entity also. The new entity also. Put together, the combined value will jump significantly. Any doubts on this 1350? Any doubts on 1350? Clear? So now 5400 plus 1350 is combined value, plus 1350 is the combined value. What is that 1350? 900 and 450 is the synergy gain. 900 plus 450. What is that 450? Increase in growth rate by 2%. 2% increase in growth rate is giving extra value of 450 rupees. Is giving extra 450 lakh, whatever, extra value of 450 lakh. I'll repeat again. Earlier 5400, no change there. Earlier 900, 900 is becoming 1350. 900 is becoming 1350. Why is it becoming 1350? Because of the increase in growth rate. How much is the increase? 6% is becoming 8%. Even a 1% increase in growth rate can jump the value significantly. So this is 6750. Tell me the share price balancing figure. 187 point. Now net cost, I'm not doing the same thing. Consideration paid minus the pre-merger value. What is consideration paid? 187.5 into 6 lakh. 187.5 into 6 lakh. So you can see the calculation beyond this. 187.5 into 6 lakh. Net cost is 225. Net cost is 225. Clear? Any doubts in this? And what is the overall gain from the merger? 450. In that 450, I gave you 180 in the first scenario. Balance is my gain. I gave you 270 in the 225 in the second scenario. Balance is my gain. 180 balance is mine. 225 balance is mine. There is a cash offer. There is a stock offer. There can be a cash offer. There can be a stock offer. Able to understand the logic? Whenever there is a revision in growth rate, you will have to think about Gordon's formula. That formula can only take care of changes in growth rate. Changes in growth rate can only be taken care by that formula. Any doubts on this? Can we proceed? Book value per share, because we'll be using this term in this question which we're going to do. Book value per share. What is book value per share is net worth. What is net worth is? Book value per share is, there are two types of value per share. One is market price per share, which is given by the stock market. Second is called book value per share. What is book value per share is net worth divided by number of share. Net worth divided by number of share. What is net worth? You can calculate through liability side. Share capital plus reserves and surplus minus P&L debit balance, miscellaneous expenditure not yet written off. All this you subtract it, divide it by number of share. Or total assets, remove the fictitious ones, remove the current liability, remove the debt capital, remove the preference capital, divide by number of share. Divide by number of share is called book value per share. Very simple formula: share capital plus reserves and surplus divided by number of share. You will have to do it for the first company, second company, and then once you are done with both the companies, you will get your values, and that could be a basis. That could be a basis for deciding the exchange ratio. Example: fixed assets 20 lakh, current assets 30 lakh, 10% loan 2 lakh, current liability 8 lakh, P&L debit balance 5 lakh, number of shares 2 lakh. Can you calculate book value per share? How much? 20, 22.5. Okay, listen. It is 20 lakh plus 30 lakh minus 2 lakh minus 8 lakh. Don't subtract P&L debit balance because it's not part of the asset. P&L debit balance is already not part of the asset. What will I subtract it? I have to ignore P&L debit balance. So earlier formula said total assets minus fictitious asset. What is total asset? Fixed asset plus current asset plus the fictitious. Fictitious is already not added in the asset. What are you going to subtract it? You cannot subtract it now because it's already not added as part of the asset. What can be other approach? This, where we'll have to 100% subtract. Total assets of the company 25, P&L debit balance part of total asset. P&L debit balance part of total asset. Go ahead and subtract it. Go ahead and, if it's already part of total asset, obviously you'll have to subtract it. This is in fact a complex example. ICA may not even test this much. They'll give share capital, they'll give reserves and surplus. You just put a total and close it. That's what we are going to do from a problem solving. Clear? What is book value per share? Share capital plus reserves, and this is the formula mostly used. Okay, share capital plus reserves and surplus minus fictitious asset. Fictitious also will not be there in most of the question, divided by number of equity share. Clear? Okay, before I come, another concept: free float market capitalization. I'll have to discuss this also. Let's understand what is free float market capitalization. Okay, in a company, we first calculate something called as market capitalization. What is market capitalization? Is value of company, MPS into number of equity share. Today, if you take, maybe let's assume TCS, they could have a market cap of around 3 lakh crore, 4 lakh crore, whatever number. Okay, let's just take 3 lakh crore. In this 3 lakh crore, in a single day, buying and selling can happen for 1000 crore, 2000 crore, 3000 crore, 5000, 10,000, any number it can happen. Normal expectation is promoters will not be doing daily buying and selling. Promoters will not do daily buying and selling, and in fact there are restrictions also from your SEBI side and all, because these guys have information, they cannot be doing buying and selling on a frequent basis. So of this 3 lakh crore, there is a promoter holding and balance is called public holding. Balance is called public holding. Public holding is called free float market cap. What is free float? Float means what can be bought and sold. So promoter shares are normally not bought, normally not sold except for certain specific instances. Public shares, I buy today, tomorrow sell, day after tomorrow buy, again sell, again buy, again sell. I can keep doing it. Promoters can't do that. Promoters can't do that. So of the total value into 100 minus promoter holding or percentage held by public, percentage held by public, free float market capitalization, shareholding by non-promoters or shareholding by public, overall value into percentage shareholding by non-promoters. Why is this coming to picture? Refers to the value of a publicly traded company's outstanding share that are available for trading by investors in the open market. Investor can buy, investor can sell. All this can keep happening. That is called free float market capitalization. What is the purpose of learning this? You will understand when I do a question. But free float market capitalization will come at 5-6 places in different problem. Free float market capitalization is shareholding by non-promoters, technically shareholding by public, shareholding by public. Free float market cap is 400. Promoters hold how much? 80% of the company, which means public is holding 20% of the company. That 20% is 400 lakh. The 20% is 400 lakh. So 20% equal to 400, 100% equal to 2000, 100% equal to 2000. 2000 divided by 10 lakh share will give you the share price, divided by 10 lakh. There are 10 lakh shares in the company. Public holding is there, promoter holding is there. Why is this term coming into picture? Reason is free float market cap could be given in few problems, and logic for free float market cap is shareholding by non promoters, shareholding by non promoters. Clear? Any doubts on this? Impact of bonus: increase in number of share, increase in number of share, and EPS, MPS, BVPS will go down. Overall value will remain same, overall value will remain same. Only one type of a company should ideally declare a bonus and split, which they are not doing. MRF is saying very clearly, I don't want shareholders who are not ready to invest for a long term period. So they are keeping their share price around a lakh rupee. If you are seriously interested in the company, then only you will buy. Some people who are just doing buying selling may not get into that counter itself. So they don't want investors who are not seriously interested, and they are not doing split, they are not doing bonus. If you look at other companies like TCS, Infosys, if they had not done any split bonus, their share price also today would have been 3 lakh, 4 lakh, 5 lakh, 10 lakh, something like that would have been the share price. So many companies keep declaring bonus. Split and all is not split, you can do only till some level. If you had 100, you can bring it to 5, you can bring it to 2, you can bring it to 1. After that, companies will keep doing bonus. They'll keep doing bonus. Purpose of bonus is to increase the number of share, reduce the share price, overall value will remain same, overall value will remain same. So next is decomposing of share price. What is decomposing of share prices? Price, whatever you calculate, can be broken down into two: EPS into P multiple. It can be broken down as EPS into P multiple. EPS can be called as ROE into BVPS. What is ROE into BVPS? Return on equity is equal to EAES by amount of equity. EAES by amount of equity. This is learnt as part of ratio analysis. One thing I should have told in the session 1 itself before the next session. Anyway, I'll be discussing in the next session, but I may not discuss much. In the security valuation topic, one concept will be on ratio analysis. I think concept 20, 25, I don't know the number. Go through all the ratios once, because suddenly in one question I'll say inventory turnover ratio, suddenly I'll say return on equity, suddenly I'll say ROI, suddenly I'll say GP ratio. It will be in security valuation chapter. You will find ratio analysis component. Just go through it once. You will need to be aware of all the ratio. Any question, suddenly a random ratio may get discussed. So ROE is EAES divided by amount of equity. EAES, if you divide by number of shares, is called EPS. Equity, If you divide by number of shares, it's called book value per share. It is called book value per share. So my EPS can be broken down as ROE into BVPS. Why this is calculated is ROE into something called as retention ratio, which is called growth rate. All of this done at CA Inter. Okay, ROE into retention ratio is called as growth rate. This will be one computation which we will come to it. Any doubts till this? So decomposing of share prices, price can be broken down into EPS into P, which we have been doing in many questions. EPS can be broken down as ROE into BVPS. ROE multiplied with the retention ratio will ultimately give you the growth rate. Once you calculate the growth rate, you want to do any valuation, Gordon's formula will help. Gordon's formula will help in the valuation once the growth rate is calculated. Any doubts till this? Next point. How is final exchange ratio decided in negotiation? I explain something called as a minimum exchange ratio, maximum exchange ratio. You say you want in your mind you want a 2:1. I was very happy to give you 5:1 and all. That was the maximum in my mind. Your mind, you have the minimum number. But what will you tell me? You will tell I want 10:1, 15:1, 16:1. You will talk about a very high number. I'll talk about a very low number. Ultimately, what will be the final exchange ratio depends on who's stronger in the negotiation. If I am stronger, I'll pull down the number very less. I'll say I'll give you very less. If I am stronger, final exchange ratio will be closer to the lower limit. In my mind, I have the maximum limit, but I'll pull it down to the lowest limit. In your mind, you have the lowest limit, but you will pull up to the highest limit if you are stronger in the negotiation. It is not necessary acquiring company is always stronger. Rare scenario, target company can also be stronger. Final ER, stronger company is one which has a better P multiple, better growth rate, better brand value, better cost of capital, better ROE. If I am better, I'll pull it down closer to lower limit if AC is stronger. If I am stronger in the negotiation process, I will bring the number down to the lowest value. Where will this come into picture? You have 5 parameters. If you have 5 parameters, first parameter 0.1:1, second parameter 0.2:1, third parameter 0.5:1, fourth parameter 0.8:1, fifth parameter 1:1, lowest limit 0.1, highest limit 1:1. Now we are discussing no weighted average. We are discussing I will bring it down closer to 0.1. You will take it closer to 1 if you are stronger. Clear? Any doubts on this? A Limited is the acquiring company. B Limited is the target company. They are negotiating a merger deal. Two exchange ratio are currently under negotiation. So we are discussing 1:2, 1:3. I am having better P multiple. I am having better growth rate. I am having better ROE. The final ER is likely to be closer to which number will be 1:2 or 1:3? 1:2 or 1:3? I want the lower limit. I want the lower limit, and lower limit is 1:3. 1:2 is higher limit. What is 1:2 is 0.5:1. I purposely gave it like that. 1:2 is 0.5:1 and 1:3 is point. So I would want 0.33:1. I would want 0.33:1. My discussion process will revolve around 0.33:1. Your discussion process will revolve around 0.5:1. If none of us are stronger, in between 0.4, 0.3, some number we can decide and then proceed ahead. But if I am stronger, I'll pull it down very close to 0.33. Any doubts on this? Okay, next concept is intrinsic value. What is intrinsic value? Is real value of the company. Intrinsic value is real value of the company. Today, TCS share prices, let's assume 1000. Somebody will say, no, 1000 is wrong. The real value of TCS is 1500. The real value of TCS is 1500. So, like we have MPS basis, EPS basis, book value per share basis, I can have intrinsic value as a basis of exchange ratio. What is intrinsic value? Real value. How will I calculate real value? Gordon's formula is there, Walter's formula is there, FCFE approach is there, lot of approaches are there, any approach you can do. In case none of the approaches are working, real value of company is taken as market price. The real value of company is taken as market price. One company you have intrinsic value, another company you don't have intrinsic value. Market value is intrinsic value. Market value is intrinsic value. What is intrinsic value? Real value of the company. Real value of the company. Example: A Limited wants to acquire B Limited. MPS of A is 40 and 20. A Limited has estimated the intrinsic value to be how much? 30. Your intrinsic value is 30. What is the exchange ratio on the basis of intrinsic value? My intrinsic value was 40 only. My intrinsic value is 40, but your intrinsic value is 30. MPS basis 40 is to 20. Intrinsic value basis 40 is to 30. Can I calculate my intrinsic value? Maybe possible, but if not given, I can't do anything. My intrinsic value could be more than 40. I have no idea. So my value is 40, your value is 30. If I go with market price, my value is 40, your value is 20. Your value is 20. Able to understand this? Okay, let's proceed first with the balance concepts. Once those concepts are done, we'll quickly discuss this, maybe another 1 hour, 1.5 hours kind of discussion in mergers and acquisition. The balance concepts are: one is exchange ratio based on adverse parameter. I've already discussed this when I was discussing initially, but again a specific focus on this. What is adverse parameter? Something which an organization wants to minimize. Example: NPA, expense ratio, COGS ratio, operating expenses ratio. If these are basis, write the base value, and the base value is the final exchange ratio. Example: gross NPA 40% for bank A, 20% for bank B. Number of shares in bank A 40 lakh. B is planning to acquire A. B is planning to acquire A. Base values are 20. B is acquiring 20 is to 40. Final exchange ratio is also 20 is to 40. The final exchange ratio is also 20 is to 40. B is acquiring A, 20 is to 40. Final ER is also 20 is to 40. If it was a favorable parameter, you will have to do swapping of that. Adverse parameter, no swapping is needed. Favorable, adverse does not mean it is good or bad for me. Favorable or adverse is on a standalone basis. Clear? Next, we have one question on bank merger, where two ratios you will have to remember. You could have maybe seen this at some places earlier and all. There used to be bank accounts in accounting and all. I think now they have removed, but let's understand these two ratios. First ratio is gross NPA percentage. What is gross NPAs? NPA non-performing assets, loans which are going bad for the company. So gross NPA percentages, whatever is the NPA divided by the loan given. NPA divided by the loan given. Why are we learning this? Because in one question they'll talk about gross NPA calculation. Gross NPA in rupees divided by advances. Advances means loans given by the bank. Similarly, we have capital adequacy ratio. What is capital adequacy ratios? Every bank, when they give loans, against the loans, because loan is their asset, for the bank loan is their asset, they need something in the liability side. Bank can take money from public, give it as loan. Take money from public, give it as loan. But RBI rule says that along with taking loan, you also need to put your own money, which is called capital adequacy ratio. I put 100 rupees, I take loans of 500 rupees. What is loan? Fixed deposit. SBI FD is a loan taken by them. If you create a FD with the State Bank of India, they took a loan from you indirectly. So whatever loans they are taking, they need to add some portion of their capital, which is called capital adequacy ratio. The formula for capital adequacy ratio is net worth. Net worth is my money divided by risk weighted assets. What is risk weighted assets? Is in the asset side, I will have fixed assets, I'll have cash, I'll have home loans, I'll have education loans. whatever loans I give, there will be a risk attached to every loan. Some loans will have high risk, some loans will have lower risk. We call it as risk weighted assets. Example, net worth of bank A 100 lakhs, capital adequacy ratio 16%. What is capital adequacy ratio? Capital adequacy ratio is equal to net worth divided by risk weighted assets. First company has a net capital adequacy ratio of 16%, net worth of 100. Can you tell me the RWA figure? What are the risk weighted assets of the first company? 625. That is, I have given various loans. I have some assets. All this, the value is 625 lakh. The value of all assets. What are the assets for me? Land, building, plant, machinery. All this will be very limited for a bank. What is primarily? Housing loans, education loans, commercial loans, all these infrastructure loan I would have given. Every loan I give, depending on something called as a credit rating, risk weights will be attached, and risk weighted asset is 625. This is first company. Second company, 206%. 206%. So capital adequacy ratio is 6% is equal to 200 by RWA. Tell me the RWA for the second one. 3,333. Combined together, 200 plus 100. Risk weighted assets 625 plus 3,333, and that will give me the capital adequacy ratio. Combine this net worth addition, RWA addition, net worth addition and RWA addition. What is risk weighted assets? Every loan a bank gives. For example, it gives a loan to Tata's. The risk weights could be 50% only. 100 rupee loan, but the risk is very limited. Giving a loan to a startup, risk could be 150%. So there will be risk weights attached to every loan being given. This risk weights are practically attached with a credit rating. Once the risk weights are attached, you'll be able to add the loans given by them with their risk weights, add the net worth which they have, and is the net worth sufficient or not. First company has 16, second has 6, together somewhere in between you will have that number is 7.58. Net worth added, risk weighted assets added, and combined together is 7.58%. Once I've explained this, I'll be doing a bigger problem, but this is the only concept. The concept is only this. We'll be talking about capital adequacy ratio, and we'll be talking about something called as NPA percentage. Any doubts in this? Similarly, advances of bank A 1000, NPA percentage 20. NPA percentage 20 means 20% are bad loans. 20% are bad loans. So of the 1000, 200 is bad. Of the 1000, 200 is bad. Second bank, 2000, and bad is how much? 100 lakh directly given, 100 lakh. Put together 200 plus 100, 300 bad. Put together 1000 plus 2000, 3000. 300 on 3000 is the NPA of the merged bank. I'll explain again. First bank, 1000 lakh advances, 20% bad. 20% is 200 bad. NPA is bad loans. Bad loans is recovery is very difficult. Second bank, 2000, 100 lakh. Technically, if they ask percentage, 5%. First bank, 20%. Second bank, 5%. Weighted average, somewhere between, which is 10%. Any doubts on this? Able to understand this? So, two items are there. One is GNPA. Second is capital adequacy ratio. If you have understood the example, doing problem is just formality. We are going to do the formality and complete it, but it is just doing a formality. Clear? Any doubts on this? So, three things we have learned. One is adverse parameter. You will see that adverse parameter in the problem I'm going to do. Adverse parameter, no change. Adverse parameter, no switching of the base value. Base value is equal to final exchange ratio. Again, I'm repeating, adverse parameter is identified on the basis of nature of the parameter and not on the basis of my value, your value. All that does not really matter. Clear? Okay. Bonus issue to reduce promoter holding. There is one ICI question around this. I'll first explain it. as per your SEBI norms, there is a limitation on the promoter holding. Certain, I have not read the whole guidelines, but there can be some restriction. So a problem will be there where they'll say promoter should hold only 50%, 60%, 70%, 80%. So what is happening is today 100 shares are there. I am holding 90% of this. So I hold 90 share. Minorities are holding 10%, 10 share. Question will say, I want to bring this down to 75%. Practical world, 90 shares are there. I'll sell 15 share. I'll sell 15 share and bring it down to 75%. Very logical thing to do. If I have to reduce my shareholding, I'll sell it and get money. Question says, no, you will not sell it. You will continue to have 90. But allot free shares to minority shareholder. Allot free shares to only minorities. Bonus issue. Bonus issue only for whom? Only for the minority shareholder. If you issue for both, then if you issue to me, the percentage will remain same. Only for minority. So earlier 90 shares, 90%. Now 90 shares is 75%. Can you tell me what will be overall share now? 90 is 75%. 120. Which means I'll allot extra 20 shares to minorities. Extra 20 shares to, why am I doing? I have no idea. Extra 20 shares to minorities, I'll be issuing free. How many shares minorities have today? 10. On top of it, give them another 20. 2:1 bonus issue you make. 2:1 bonus issue you make and give free shares to minority shareholder. This is the concept. Promoter shareholding is reduced to comply with SEBI norm, and this is done by giving free shares only to minority shareholder. Post bonus, how many shares will be there? 90 shares of mine divided by 70, 75, 80, 85, whatever percentage. Number of shares allotted, how many shares are there after 120? Today, how many shares are there? 100, and this will give bonus ratio. I think this example only I've ended up discussing. Promoters hold 90% of the company. They are planning to issue bonus shares to whom? Minority shareholder to bring down to 75%. Practical world, I will just sell the share. Why will I bring down my shareholding like this? But the question is saying, clear? Understood this? Okay. What is fund available for mergers? I am planning to acquire a company. For acquisition, one approach is giving shares. Another approach is giving cash. For giving cash, I need to see whether do I have the funds or not. Do I have the funds or not to acquire a company? Where does the funds come from? Funds come from cash and bank balance, marketable security, any short-term deposits I have, and the loans which I can take. I can take loan also to acquire a company. But for taking a loan, bank may have some condition. I personally can have some condition. What is personal condition? My debt equity ratio should not exceed 1:1, 2:1, 0.5:1. So what is the liquidity available to acquire a company? How do we calculate? First is what is maximum debt potential? What is maximum debt? Net worth of mine into debt by equity. Net worth will not go up because I acquire only the business. I am not giving any shares to that party. I acquire their business. So net worth into debt by equity. Debt by equity. This is my maximum debt. In this maximum debt, I already have some debt. Acquiring company already has some debt. When I acquire the other company, their debt also will sit in my balance sheet. This tells me how much new borrowing I can take. I'll always have a limitation. You cannot say that you can take Bharadwaj Institute can't acquire a very big company and all, because we will have limitation. Tatas may acquire a very big company and all. So this will tell how much borrowing I can take. Along with that, I may have some cash and cash equivalent. Put together, this much is the total fund available to acquire a company. Let's see a very simple example. Equity capital is 2 crore. Both A and T have arrived at an understanding that debt equity ratio should be what? 0.3:1 of the merged company. Of 2 crore into 0.3 by 1 can be the borrowing. 2 crore into 0.3. Why 0.3? It can be higher, lower. That's their understanding. 2 crore into 0.3 by 1. So I can have a borrowing of, along with equity capital, reserves and all can be added. It's not there. Then I say, I already have 20 lakh. You are bringing in another 10 lakh. So 20 plus 10, already borrowing is there. Extra borrowing I can take is another 30 lakh. Extra borrowing I can take is another 30 lakh. I went to the bank, asked for a loan. Bank said 30 lakh we can give you. I also have marketable security of how much? 40 lakh. Put together 70 lakh is available. If I want to acquire you, I can pay 70 lakh cash to you. I can pay 70 lakh rupees in the form of cash. Other option is share consideration. But if I'm acquiring, I can pay you 70 lakh rupees. That is the total fund available for merger, or technically total fund available for acquisition. It's a fund available for acquisition. I'll repeat again. 2 crore is my net worth. 0.3 is my debt potential. Debt equities into 0.3 by 1. 60 lakh loan I can take from bank. Went to the bank, asked for 60 lakh. Bank said, already you have 20 lakh. You also have another 10 lakh which is coming from the other company. I'll give you extra 30. On top of that extra 30, marketable securities 40 lakh. Put together 70 lakh. Now the question may say, can you acquire a company which is worth 75 lakhs in this scenario? Answer is no. I cannot acquire because I have only 70 lakh rupees. I have only 70 lakh rupees. Can I acquire a company for 65 lakh? Yes, I can acquire a company for 65, 60, 55. I can afford to pay maximum only 70 lakh in this scenario because that much only liquidity is available. I want to acquire a 80, 90 lakh company. Go ahead and issue shares. If share consideration is possible, go ahead and issue share. Not possible, maximum cash you can pay is 70 lakh rupees. Liquidity available to acquire a company. Liquidity available to acquire a company is 70 lakh rupees. Clear? Any doubts on this? All these, when you do your revision, should take one minute. It is just a one minute concept. I'm explaining in depth, but it's just one minute concept for you to understand. And suddenly it can come as part of a bigger question. Any doubts on this? Oh, this is okay. Post-merger shareholding, this doesn't really matter. We did one question that Abhiman and Abhishek. I was holding 50%, 60%. Weighted average was some 54%, which is what this formula is. You can see this later at home, the MCQ. I could be holding first company shares. I could be holding second company share. When merger happens, my shareholding would be between 50 and 60. Here, I think I hold 10, 5. Merger happens between 10 and 5, some holding will be there. You see this later at home. Doesn't really matter. Post merger holding is existing shares plus new shares issued divided by existing shares plus new shares issued. Any doubts on this? Okay. Distribution of shares in case of partly paid share. Now, what is partly paid share? Let's understand. You did your analysis. Let's assume you did this. It said you wanted to issue 262 500. Suddenly a surprise comes now. I said I'll give you 262 500. You are saying some shares fully paid up for me. Some shares are partly paid up for me. How do I distribute now? Because 262 500, I wanted to distribute to two sets of shareholder. Few people fully paid. Few people partly paid. Now I cannot say that I'll give you exactly same number, which is not logical, because fully paid guys will fight saying that I have already paid full money and you are giving me half a share. This guy is partly paid. Again, you are giving half share. Not logical. You need to do something here, which is what this concept. There is a bigger problem on this. I'm not going to do the problem. You can do later at home. It's a study mat question at home, but I'll first explain the concept. But that's a study mat question is there. Question 33. It is in chapter 13. Okay, it is there in both the chapter. Question number 26 of this chapter and question number 5 of chapter 13. This question is there where this concept will be discussed. You can do later this at home. Let's not worry much. Let's understand the concept now. Okay. We have decided, I'll show with the example only. A Limited will issue 1 lakh shares as a consideration to B Limited. I want to give you 1 lakh share. B Limited currently has 30 lakh shares. So consideration 1:30. But then you give me a surprise. What is the surprise? 20 lakh shares of 10 each fully paid, and 10 lakh shares of 10 each partly paid. Now allotting 1 is to 30 is not logical, because some are fully paid, some are partly paid. Either convert all fully paid into partly paid, or convert all partly paid into fully paid. One of them we have to do. How many shares will be issued to Mr. A, who's holding how many shares? 1 lakh fully paid, 1 lakh partly paid. So he is saying, give me share. He says, I'm okay with 1 is to 30, but others will start arguing. So how will we distribute the shares in this scenario is what we are going to discuss. I have 1 lakh shares to be issued. Other company is having 30 lakh share. Logical 1 is to 30. Logical is 1 is to 30. But argument suddenly came in saying that 20 lakh is fully paid, 10 lakh is partly paid. How will we do this? Now listen. Breakup of this 30 is 20 fully paid, 10 partly paid. Partly paid, how much we have paid? Half paid, half unpaid. Half paid and half unpaid. This partly paid is equivalent of 5 fully paid, because you have paid half. If you had paid 20%, equivalent of 2 lakh fully paid. So the other company does not have 20 plus 10. Other company has only 20 plus 5, 25. Other company has 20 plus 5. What is this 5? 10 partly paid is equivalent of 5 fully paid. How will I distribute now? Exchange ratio is 1 is to 25. If you are a fully paid share, get 1 is to 25. If you are a partly paid share, convert your partly paid into fully paid and get 1 is to 25. Convert your partly paid into fully paid and get 1 is to 25. Other option is converting everything into partly paid, which is not needed. Convert everything into fully paid. A fully paid guy will get 1 is to 25. A partly paid guy will also get 1 is to 25, but first you convert. How many shares am I holding now? 1 lakh fully paid, 1 lakh into 1 by 25, 1 lakh partly paid, 1 lakh fully paid, equivalent 50,000 fully paid, equivalent 50,000 fully paid, 1 lakh 50 into 1 by 25 into 1 by 25. Able to understand this? I'll repeat again. In this question, what we have to do is, I have 1 lakh shares, consideration is already decided. Now you don't come back to me saying that that's your headache. Among you, you decide what you want to do. I will give you 1 lakh share. Now you are saying we have some fully paid guys, some partly paid guys. I say this is a headache to me. You decide what you want to do. Don't break my head on this. Then you yourself do convert partly paid share into equivalent fully paid share. Exchange ratio, shares allotted into total fully paid share. Allot shares based on this to fully paid and partly paid shareholder. Fully paid 1 lakh into 1 by 25. Partly paid 1 lakh become 50,000 into 1 by 25. Clear? Any doubts on this? 6,000 shares. You want to solve a question on that? That question is that problem which I talked about. It is your study material question number 26 or question number 5 of chapter 13. Both the places the same question is there. And in my question bank, it is question number 33. Okay, another concept which came in May 24 exam: minimum consideration for promoters to relinquish promoter holding. I did some time back a minimum exchange ratio and a maximum exchange ratio. Minimum exchange ratio was your pre-merger value, or to put it very simply, you want minimum price is whatever is the current market price today. If price is 25, please pay me 25. Price is 30, please pay me 30. That is always the minimum price. Minimum price is what? Whatever is the price in the market. If I'm giving a cash consideration, if I'm giving a stock consideration, equivalent that much I want. You are a minority shareholder. You wanted this. I said, let's assume price today is 30. I want to pay 30 rupees. You say, I'm okay with it. Minimum, you give me 30. Anything more, very happy. But minimum, I want 30. I am the promoter. You came to me saying that you want to acquire the company, pay 30 rupees. I say, no, no for 30. There's a reason for saying no. Reason for saying no is I was earlier cheating you all guys. What was I doing is I am the promoter. Because I am the promoter, managing director, myself, my relatives, all top position in the company, and I was giving extra remuneration to all these people. When I give extra remuneration to these people, what will happen? PAT will go down, EPS will go down, market will start giving lower value. So I say, give me 30, also compensate for the fraud which I was doing. When I say fraud which I was doing, I was paying myself extra. I want something for that also, because moment the company is acquired, first thing he will do is remove promoter, remove these people. So he wants, listen here, promoter can enjoy allied benefit. What are the allied benefit? Higher remuneration due to majority shareholding. Hence they need to be compensated also for these. What is the minimum price they want? Existing price plus value of all these allied benefit. Value of all these allied benefit. Logically doesn't make any sense, but you will say you want value of all allied benefits divided by the number of shares. The value of that can be 10 lakh, 20 lakh, 30 lakh, 50 lakh, 80 lakh, 100 lakh. So you want market price, and on top of this a compensation for this. This is there in your mind. You may discuss it saying that I want minimum 35 rupees. I'll ask price is only 25. Why are you asking 35? I'll say I want 35. You want to give it. Otherwise, we are not selling the business. We are not selling the business. Logic is very simple. I want my price plus a compensation for the cheating which I was doing against minority shareholder. Technically, it's a cheating against minority shareholder because I was overpaying myself. And for this overpayment, I want compensation from the shareholder. Let's understand this. Current market capitalization 40 lakh. Promoter hold 40% of the company. So promoter is holding 16 lakh rupees. I want you to give me 16 lakh plus number of shares is 1 lakh. Promoters and their family members are part of the top management, and are currently overpaid. They had received excess remuneration of 2 lakh per year. 2 lakh first year, second year, third year, fourth year, fifth year. And the present value of this remuneration for infinite period is 15 lakh. Can you please give me 40 lakh into 40%? Another 15 lakh. You have to give me 40 lakh into 40%. Minority shareholder says, no, don't give me all that. Just give me the price. I want two compensation. One is the price. Second is the fraud angle, which I've been doing till now. Technically, you can call it as a corporate governance issue, but I want compensation for both. So what I want, 40 lakh divided by 1 lakh, 40 rupees plus extra 15 lakh for the 4 lakh shares, for the 40,000 shares I'm holding. Extra 15 lakh for the 40,000 shares. Existing MPS plus value of allied benefits divided by number of shares held by promoter. Minority shareholder, just give me 40. This guy says, give me 40. What is 40? 40 lakh divided by 1 lakh, 40 rupees, and give me extra. Able to understand this? So he wants 77.5. There's another. So a student is asking 40 into 40%. That is also okay. 40 into 40% is 16 lakh plus another 15 lakh, 31 lakh divided by 4 lakh, or 40 rupees plus extra 15 lakh divided by 40,000 share. Put together, you have to give me 77.5 per share. You don't give me this, I will not sell the share. You don't give me this, I will not sell the Sure. Able to understand this? Any doubts on this? DuPont framework for computing return on equity. ROE is something you would have learnt at CA Inter. There's something called as a DuPont framework, which also you would have learnt, but maybe many of you would have forgotten it. So let me spend little bit time. ROE formula is EAES by amount of equity. A company wants to improve. Okay, there's a doubt from Bhavesh. Maximum price is merged value minus value of acquiring company. Answer is yes. Merged value minus value of acquiring company is right answer to the previous question. What is merged value? Today's value of acquiring company plus all of this. All of this is what is will be added. So this is what I give as consideration. This is what I give as consideration. This is a doubt from one of the student. So what I give is all of this, because all this will get added to my value. All this will get added to my value. I give this as the consideration. I give this as the maximum consideration. Okay, coming back to this. An organization wants to improve ROE. Bharadwaj Institute wants to improve. I say improve PAT, reduce equity. They say, no, I don't understand all this. Can you break it down? So DuPont has broken this into subparts. What did he say? PAT by sales into sales by assets into asset by equity is ROE. PAT by sales, sales and sales will get cancelled. PAT divided by sales into sales divided by asset into asset divided by equity. So if you want to improve ROE, first thing improve net profit margin. Bharadwaj Institute says we cannot improve net profit margin. We cannot charge more to the student. Improve asset turnover. What is asset turnover? A sales by asset. Today, let's assume this is our own building and all. Today we are doing 2 batches. Increase 3, 4, 5, 6, 7, 8. Increase more batches. Automatically asset turnover will improve ROE. So first way is improving net profit margin. Not possible. Improve asset turnover. Not possible. Improve equity multiplier. What is equity multiplier? Is asset divided by equity. This is little risky. What is asset divided by equity? I have my money 100, but I bought 1000 assets. I bought 1000 assets. How? By borrowing, obviously. Balances through borrowing. So either put lesser of your money and buy lot of assets. That can improve your ROE, but it is little riskier one. Or improve asset turnover, or improve net profit margin. This is what DuPont said. DuPont said ROE can improve. ROE can improve by 3 parts. Either net profit margin, or asset turnover, or equity multiplier. Why are we learning this? Reason is this example. Net profit margin is 4%. Asset to sales ratio is 0.8. I don't like this. I need sales by asset. I need sales by asset, which is 1 divided by 0.8. Debt to assets ratio. What is debt to assets ratios? Debt is 0.4. Asset is 1. Debt is 0.4. Asset is 1. Debt to asset ratio. Debt is 0.4. Asset is 1, which means equity is 0.6. Asset is 1. Debt is 0.4. Your asset is 1 rupee. 40%. 40 rupees debt, 100 rupees asset. Balance is equity. Balance is, if I prepare a balance sheet, debt, equity, asset. Debt is 40, asset is 100. Equity is balance. Equity is balance. All this, ideally, I should have told you previous session itself that you should have gone through ratio analysis, because if you go through ratio analysis, all this would have been little easier for you to grasp at this point of time. So net profit by sales, sales by asset, asset by equity will give me the ROE. Will give me the ROE. To calculate return on equity, the formula we use is net profit by sales, sales by asset, asset by equity, asset by equity. Net profit margin is given. Asset to sales, inverse it and write sales by asset, and the other one is asset by equity, which is calculated using your debt to assets ratio. Balance is equity to assets ratio. There is a debt to asset ratio, there's a debt to equity ratio. All this you will understand in the ratio analysis. My request is When I discuss next chapter, before that, one time you go through all the ratios. Any doubts till this? Clear? If at all you want to practice a question around it, I'm not doing it. Question 37 of the concept of the main question bank. I don't see it to be a very important question. It's not a priority material question, but still you want to practice, you can practice this question. You want to ignore, you can ignore this question also. Doesn't really matter according to me. One thing you need to be aware is how is ROE computed as per DuPont framework. ROE as per DuPont framework is net profit by sales, sales by asset, asset by equity. Any doubts on this? Can we proceed? Clear? Okay, I think there is some numbering issue. This should have been number 30, but okay, we are already reaching to the end. Internal reconstruction. You would have learnt this at CA Inter. I'm not going to do anything around it, but there is one problem. I'll tell you. You do this at home. Why we are doing this? The heading of the chapter is mergers, acquisition, and corporate restructuring. Restructuring means internal reconstruction. ICI has given one question in your study material. In your study material on internal reconstruction, so you will have to do that question at home. What is internal reconstruction? There will be something called as capital reserve. There will be items which is increasing net worth, items which is reducing net worth, and you will prepare a revised balance sheet post reconstruction. I don't even do it in my regular class, this question, so 100% I'm not going to do it now, but at home you may want to do this question. This is exactly CA inter question, okay? Nothing of CA final. Question 40, corporate restructuring, illustration number 1 of study material. Illustration number 1 of study material. Any doubts till this? Any doubts on this? We are almost done with the chapter. I may have to do 2-3 more questions, but almost done with the chapter. Any doubts? Okay. There's one more item which is little illogical. I'll explain this with the question itself because it is slightly illogical. If I even explain, you will not understand this. I'll explain this with the question now. Any doubts on any of the concepts? My concept discussion is over. I'll be revising all the concepts in some time. Any doubts on this? Any doubts in any of the concepts? Let's come to this question 41, study material question number 15 and question number 22 of the priority material. Let's do this question. I'll give you a minute. Please, you read this first and then I'll start explaining. Go through this question. Okay. Centurion Bank and Bank of Punjab are planning to merge. Total value of the company is dependent on the fluctuating business condition. The following information is given for total value debt plus equity for each of the two companies under a high growth scenario, a medium growth scenario, and a slow growth scenario. Centurion Bank value is given, Bank of Punjab value is given. Current debt of Bank of Punjab is 65, Centurion is 460. Calculate the value of debt and equity separately for the merged entity. I'll do it fully and then I'll explain the small disconnect which I have with this question. Reason for doing it is only it's a study mat question. Otherwise, I would have skipped this problem. Now, calculation, everything is very simple. Nothing very tricky. You need not even do it. Just be in listen mode. Nothing tricky in the calculation. I have value of 820. In this 820, 460 is debt, balance is equity. Debt is 460, balance will be equity. Equity is always residual figure. Be in listen mode. I don't want you to solve anything, okay? 820, why 460? Centurion Bank, they've changed the order here, okay? 65 is Bank of Punjab and Centurion Bank is 460. So 820, debt is 460, equity is 360. 550, debt is 460, equity is 90. 410, debt will be 410 only and equity will be 0. Equity will be 0. What we need to do? Add these weights, do weighted average. 0.2 into 460 plus 0.6 into 460 plus 0.2 into 410 is the expected value of debt, and expected value of equity is 0.2 into balance 360, 0.6 into 90 and zero point 0.2 into 0. This is technically called as valuation of debt and equity. Nothing wrong in this. Very logical. I have no problem with this approach. I'll explain again. 820 is the value. Debt guys will take money first. Balance will go to equity. 820 becomes 5,000. Debt guys will get 460. Balance equity guys will enjoy. Equity guys is always residual figure. So of the 820, 460 for debt, balance is for equity. Same way you will do it for Bank of Punjab. So weighted average is 450, weighted average is 126, weighted average is 65, weighted average is 758. 450 plus 65 is the merged value of debt. 126 plus 758 is the merged value of equity. Where is the disconnect? Disconnect is moment merger happens. Moment merger happens. 410 plus 590 will become 1000. 410 plus 590 will become 1000. Moment it becomes 1000, debt guys will not suffer this loss. The debt guys will not suffer this loss. What is debt guys suffering loss? When it is individual company, you are not able to pay 460. Moment merger happens, 410 plus 590 is 1000. That can easily pay 460 plus 65. This analysis is getting missed out in the merged company. When you merge it together, you prepare a table. When you prepare a table for the merged entity, that answer will not be 450 plus 65. You will get an answer as 460 plus 65. When you do at home, if you do the combined entity like this, the combined value will be 460 plus 65. Nothing much for you to understand. In case it gets repeated in exam, I'll explain again. The value is given in the question. First you give it for debt, balance you give it for equity. Problem is in this low growth scenario, debt guys are suffering loss. Debt guys are suffering loss in the slow growth scenario. Which moment merger happens, this loss will not happen for the debt guys. Loss will not happen for the debt guys. Why will the loss not happen for the debt guys? Because moment merger happens, the debt guys will say Centurion Bank is there and Bank of Punjab is there. Combined value is sufficient. Combined value is sufficient to pay the debt and to pay the overall debt. My debt as well as the other debt. Any doubts on this? Clear? Able to understand this? Value of debt of merged firm, value of debt of AC, value of debt of TC. Individual debt values, weighted average of the various value at different scenario. Value of equity of AC, value of equity of TC. Individual equity values, weighted average of the various values. Only thing is, instead of adding it like this, I should have done a merged analysis. In the merged analysis, you may get a different answer. In the merged analysis, you may get a different answer. If you try at home, you will get a different answer. If you do merged together, reason is that loss which is happening will not happen for the debt guys. Any doubts on this? Any doubts on this? With this, the chapter is over. I will revise this entire chapter. Around 10 minutes it should take, or maximum 15 minutes. Let's go through the entire chapter. Nothing for you to see, nothing in your book, be in listen mode only. We started with understanding why a merger happens. A merger may happen because of two major reasons: financial synergy, operating synergy. Financial synergy, PAT improvement, operating synergy, PAT improvement. Financial synergy is P multiple or cost of capital. This is the format we'll do, analyze most of the companies. PAT, number of equity share, EPS, P multiple, MPS, number of equity share, market value of firm. The real formula for market value of firm is PAT into P multiple. Then we learned what is the gain from merger. Gain from merger is combined value minus the individual pre-merger value. Individual pre-merger value. The combined value obviously will be higher most of the time. The gap is called gain from merger. Why is it happening? Two reasons. Combined PAT more than the sum of the individual PAT. Combined P multiple better than the weighted average. Any merger gain given in the question will mostly mean synergy gain at a PAT level. If they say no synergy gain, again at a PAT level. P multiple gain can still be there. Rare scenario, this would mean directly valuation gain. One way is if they say present value of all the future number, that is technically the valuation gain. Cost of merger is what do I pay to you guys? Gross cost, net cost. Gross cost, if I give you cash, cash paid into number of share, and if I give you shares, shares issued into the post merger market price. What is net cost? Whatever I gave you minus what you had today. What you had today is today's value. Gain for AC and TC shareholder. Overall gain is, I did in concept 2. Overall gain is post merger value minus the individual pre merger value. Who is going to enjoy this? Two sets of people. What are you enjoying? Net cost of merger. Balance is called NPV, which is my gain. Balance is called NPV, which is my gain. Equivalent EPS, MPS, why does it come? For you, the calculation is you cannot have the normal EPS because your one share can become half, can become 0.25. So you have an equivalent number. What is equivalent number? The post merger EPS, MPS into the exchange ratio. For me, whatever is the normal number. How is exchange ratio determined? Identify the basis, EPS, MPS, BVPS, whatever is the basis, write the base value. Before you write, see you want to give something extra, consider the extra part. After you have written the value, switch it around and pay to the other party. Before switching, check whether the parameter is an adverse parameter or a favorable parameter. Adverse parameter, switching is not needed. If you want to do weighted average, basis, base value, swap it, shares to be allotted, multiply with the weight, get the product. The sum of the product will give you the final shares to be issued. Gain or loss per share or impact on merger. Gain or losses comparing post-merger EPS with the pre-merger EPS or MPS. And for you, equivalent post-merger EPS or MPS with the pre-merger EPS or MPS. If you want to maintain EPS, ER on the basis of EPS. A question said EPS is not to be diminished by the merger. Shareholders don't want a loss. EPS is to be maintained by me, by you, all on the basis of earnings per share. If you want MPS to be maintained, ER on the basis of MPS. BVPS to be maintained, but only condition is there should be no gain in that parameter. P multiple post merger, problem silent. P multiple of acquiring company is equal to P multiple post merger. A question may say weighted average. Weighted average is PAT into P multiple, again PAT into P multiple divided by PAT plus PAT. Minimum multiple to justify merger. In the denominator, add another element called synergy gain. Add another element, synergy gain. Valuation of merge firm, normal formula, PAT of merge firm into the P multiple. How is P multiple determined? What I said some time back. And approach 2 is my value plus your value plus valuation gain given in question are computed by us. Maximum or minimum exchange ratio. Minimum you want is your earlier value. Maximum I can afford to give. I can afford to give is post merger value minus the pre-merger value of mine itself. Minus the pre-merger value of mine. Decision on sale of share. If I want to decide on sale of share, check whether opportunity cost of capital available, not available. If not available, do gain or loss at an MPS level, decide it. Very logical. If it's available, calculate earnings yield. What is earnings yield? Is equivalent EPS divided by the higher share price today. What is higher share price? It could have gone up today. Valuation of original company shareholder. This concept assumes that no benefit will come from merger. First company value plus second company value, split that in first company shares, second company shares issued, and that is called value of original shareholder. Post merger EPS, normally if you do a share consideration, table will give you the answer. If you do a cash consideration, PAT of AC plus PAT of TC plus any synergy gain minus interest cost, after tax interest cost, which can be a loss in interest income or real interest cost for the company. Book value per share is asset side, liability side. Liability side, share capital plus reserves minus fictitious asset. Asset side, all assets. Remove the fictitious one. Remove share cap. Remove your current liability. Remove your debt. Remove your preference and get the value. Free float market cap, shareholding by non-promoter. Shareholding by non-promoter. How will you calculate free float market cap? Total market cap into percentage held by public. Percentage held by public. If you give free float, divide by percentage held by public will give you the total market cap. Impact of bonus or split, number of shares will go up. EPS will go down, MPS will go down, BVPS will go down, zero impact on overall market value. If there is a revision in growth rate in a company, calculate first KE today or KO today. How will you calculate overall dividends by overall value plus growth rate? Again, use the same formula only, which is revised in this case, and you will get the revised value. You will get the revised value. Decomposing of share price, MPS can be broken down as EPS into P multiple. EPS can be broken down into ROE into BVPS. ROE can be used along with retention ratio to calculate growth rate. How is final exchange ratio determined? We will have a lower limit. We'll have an upper limit. We will sit together. If I am stronger, I'll pull you down to the lower limit. If you are stronger, you will take it up to the upper limit. Intrinsic value means the real worth. The real worth will be taken as market price in the absence of information. If information is not there, it is taken as market price. Exchange ratio based on adverse parameter. If there is any adverse parameter, example COGS ratio or NPA, in these cases, our exchange ratio will be same as the base value. No switching is to be done. Ratio related to bank merger, capital adequacy ratio is equal to net worth divided by risk weighted assets, and NPA percentage is NPA in rupees divided by total loans given. Bonus to reduce promoter holding. First, see what is public holding today, what is promoter holding today. Promoter has 5 lakh shares. This is equal to 90%. Same 5 lakh will now become 75-70%. Get overall share. Earlier overall share. Gap is the free shares given to minority. Gap is the free shares given to minority. Fund available for merger. Total equity of my company into debt equity ratio. This will tell how much debt I can take. Debt already available in my company, debt available in your company, add cash and cash equivalent. This is the fund available for a merger exercise. Post merger shareholding, my shares plus extra shares given to the other company, whole divided by my shares plus the extra shares for a shareholder. Some specific percentage will be there. In case of partly paid share, convert the partly paid share into equivalent fully paid share, identify the ratio and start allotting in that ratio. Minimum consideration for promoter to relinquish his holding. Minimum consideration is today's price or today's value for my holding plus value of the extra benefit divided by number of share. DuPont framework says ROE is equal to net profit margin PAT by sales, asset turnover, sales by asset into equity multiplier, which is asset by equity. Internal reconstruction, identify items increasing net worth called as and items reducing net worth. The gap is called capital reserve, and then you will prepare a restructured balance sheet. You can go through that question which I've talked about. Valuation of debt and equity. In case they give a combined value, split that combined value into debt, equity. Debt will take the first value, equity will be balancing figure, multiply with various probabilities. This you do it for first company, do it for second company. Individual sum is the final value. Individual sum is the final. Taken exactly 10 minutes, and it will take only this much time for me to revise. If I want entire AFM, 40 minutes we sit or maybe 2 hours we sit together, it is done. It is done. Concept book will help you in revising multiple times. Any time you want grip on the subject, just go through concept book, concept MCQs. 100% you will get grip. Application depends on your confidence after that. That is where we are doing problems in the class. Otherwise, I will just discuss the concept. Clear? Done? We'll take a break of 15 minutes and then resume.